Applies to the new boss, Remy Cointreau. So at both of those businesses, we have new leadership coming into position. And then we were also focused on Spanish banking, BBVA and Sabadell. We've heard, of course, that the government is going to take its time on that particular M&A story. They're going to conduct their own review after the antitrust watchdog did the same, Guy.
Okay, here we go. Wednesday session. First proper session of the week, I would argue. Let's take a look at what we are seeing. Here we go. We've got a very flat picture, I think, likely to emerge. FTSE 100 certainly delivering on that front. First thing, look at that. That's an exciting open, isn't it? We're down by 0.03 of a percentage point. We'll give it a while. We'll see whether or not we see further action and whether or not there are some single stocks that we need to be focusing on. But the market is back to kind of marking time, trying to figure out what is happening, trying to understand the implications of what's coming out of Japan and the trade story and what the latest data are telling us about what the picture looks like with the global economy. Stock 600 is down an exciting 0.03%. The FTSE 100 is now absolutely flat. The CAC 40 is absolutely flat. The DAX is delivering an impressive 0.2% rise this morning. Take note of that. And the IBEX is down by 0.2%. I struggle to find a clear narrative out of the numbers that we are putting up on the screen right now, Chrissy.
I think I'll join you in that confusion because it does feel like these are very small moves, even on a micro basis that we are seeing. I mean, you are looking at kind of a split market in terms of the ups and downs, 262 stocks up, 280 down. So again, really netting out to what you're seeing on your screen right now, which is kind of an index level. From a sector perspective, though, you are seeing basic resources, technology, financial services, and construction in the red. The rest in the green, but not by much, Anna.
Yeah, and overall, these markets are flat, which is a little better than maybe we're expecting. But we're pretty divided, aren't we, when it comes to the sector perspective, so that doesn't help us too much. Energy stocks are moving higher, retail stocks are moving lower, and everything else in between seems a bit of a mess.
There's a couple of stock stories that do stand out, one of which is Rheinmetall is up again. Friedrich Merz is talking about building the biggest, most powerful military in Europe for Germany. Rheinmetall continues to benefit from that. We continue to struggle to keep up with what is happening in the defence space. That certainly continues to be a narrative that is worth watching out for. So BAE Systems is also up on that. Safran is trading a little bit higher. Rolls-Royce, I think, picks up on the back of that as well. Even to a certain extent, we are seeing Airbus. Thales is also doing relatively well.
Okay, let's get another perspective on these markets. So let's bring in Eric White-Ennis, who's the EMEA head of investment strategy at JP Morgan Private Bank. And very nice to have you with us on the programme, Eric. Thanks for coming in. So we're looking at markets that are twisting and turning almost daily still on tariff news flow. And do you have any sense, you've been thinking about the rest of the year, I know, and do you have any sense, or what assumptions are you making, if you don't have any sense of where the landing zone on tariffs is, what assumptions do you have to make about tariffs in the meantime?
I think it's important to try to recognize what the approach is here, which is a little bit outside the box, and it's perhaps not what we're all used to in terms of the negotiation. And it seems fairly clear that it's a place where things start a little bit here. There's a goal to land to a bit more of a reasonable landing zone, and that's ultimately where we think things will reside at the end of the day. Perhaps a low double-digit level on the overall U.S. net effective tariff rate, which we think is something that can be reasonably managed through a global economy that's showing an impressive ability to ebb and flex around it, particularly led by the U.S., where the dynamism of the U.S. economy is showing an impressive degree of resiliency. We think it makes sense to add strategies that will navigate this, But that flexibility has been important.
Okay, and that chimes with what we were hearing out of the White House yesterday, you know, that if this is a 10% tariff then, or maybe a little more than that in the end, then this could be something that the US economy, certainly the White House was talking about, can handle. It's not going to be such a big stumbling block, I suppose. Is that your base case then, that we don't get a recession in the United States? The data just sort of flexes a little in the short term but bounces back?
It is. We believe that the U.S. economy will ultimately skirt recession. We certainly could have a degree of a slowdown. I mean, ultimately, tariffs such as these are an upside pressure on a degree of inflation and a bit of a downside pressure on growth. But as long as that does not go too far, a degree of a slowdown isn't the end of the world for an economy such as the U.S. Remember, recessions over time are typically short-term in nature. The market typically moves ahead of that. And we are seeing that flexibility of the U.S. and the global economy, and it's been noteworthy.
To what extent are buybacks propping this market up?
It's helpful. It's a simple supply-demand type of phenomenon, and we expect to see more of those as we go moving forward. The overall attractiveness to what's been happening with earnings in the U.S. has also been producing a steady buying hand that quickly came in amidst the recent market turmoil. And there's obviously a big debate about the phrase U.S. exceptionalism. And to some, it ultimately ends up being something that sounds a little bit of an either-or. One of the things that I would encourage focusing on is the fact that the U.S. does remain the dominant center of tech, the dominant center of AI, a magnet for talent, a magnet for capital, and a place with the most innovative free cash flow producing companies in the world. And if you think about earnings growth going forward, one of the things that is sensible to ask oneself is, do you think the U.S. will continue to produce robust earnings on a 5, 10+ year type of time horizon? And if the answer to that is yes, which we very much so think that it is, we believe it's sensible to stick with the U.S.
So I take that question, I'll pose you another one. The earnings guidance and the earning increases you've seen in the States are largely based on consumers being able to digest price hikes that have come down from Europe and from the United States. But you look at the personal savings data, you look at delinquencies data, they're all ticking higher. So that price hike, which are likely coming down the pike from Walmart, Target, name your company,
No.
that digestibility feels like a red flag for the U.S., no?
There's definitely going to be a degree of headwinds that face the consumer in the months to come, and we'll see how the Fed might react to that. In particular, I think the payrolls data over the next quarter, when we're more so in the tariff digestion period, to use the word that you mentioned a couple of moments ago, that's going to be particularly important. The Fed often reminds us that there is not the concept of the so-called Fed put, but the reality is, as they focus on their dual mandate, helping to ensure prices are reasonable, i.e. help fight inflation, and also help support the labor market. If the labor market softens, I think we can expect a Fed reaction response if the consumer struggles. But just yesterday, we got a surprisingly positive number on consumer sentiment in the U.S., and that was encouraging to see.
One that was largely driven by the equity market. You can see that in the data as well. How does the Federal Reserve stop price hikes, though?
So I don't know that it can, and companies are going to do what is sensible for them. And that's where the health of the U.S. consumer comes into play. Can they digest these price hikes? What does it mean for the ultimate levels of inflation? Those inflation numbers have remained reasonable enough. We're going to get some more color on that this week, but you're hitting on some of the key dynamics. What is that mix between upside price pressure and downside pressure upon growth?
Sounds like you don't believe in Europe.
We do believe in Europe. So we very much...
You'd rather be in the U.S.?
Yes, admittedly, we would. We recently upgraded our disposition on Europe. And again, I would try to view it not so much as an either or. We believe it makes sense to stick with the U.S., but at the same time complement what is typically heavy, long, overweight positions in the U.S. with a greater degree of exposure to Europe. I am extremely enthusiastic by the Draghi report-like German infrastructure package, for example. That is a big bang type of stimulus, about 12% of German GDP, a quarter of the region's overall economy. That type of amount and that type of decisiveness is very encouraging to see, and our hope is that it helps to continue to foster greater policy support, more inflows, and that's been supportive of European and international markets. It's also a bit of the story of the downward pressure on the dollar, that flow of funds coming back to Europe.
Does it matter if I'm a European investor or a US investor? Keep everything in America. strategy. If I'm a European investor, the dollar hurts. If I'm a US investor, it doesn't matter. Do we need to be a little bit more nuanced in what you're saying in terms of where my home market is, in terms of how I think about how I'm going to be investing?
It's a great point. The home-based currency topic is a big one, and it is fair to say that for U.S. domiciled investors that are kind of U.S. dollars all the way, so to speak, they are typically a bit less sensitive to what happens with the FX market overall. But for investors that are home-based, denominated in pounds, francs, euros, and so on, there is a greater consideration of that. Ultimately, we think that U.S. market performance in the quarters and years to come will be sufficient to compensate, even if there is a degree of a softening trend in the U.S. dollar. And we are very much so in the cyclical camp for the dollar and not the structural camp. And by that, I mean we do not foresee substantial risks of the U.S. losing its base reserve currency status anytime soon. The dollar is still used in 90% of FX transactions, 2/3 of international debt, 60% of international currency.
That's a very high starting point.
It is, and its status there, we think, is very much so secure. So if the dollar continues to soften, we think it will be gradual and relatively cyclical in nature and not something that needs to be a tremendous concern.
Can I ask you about private markets and what conversations with clients are like about how much exposure you want to have to private markets? We're going to have a conversation later on in this hour, in fact, around infrastructure spending in Europe, around private equity in Europe. And we heard from UBS, Iqbal Khan, talking about how investors could still get more exposure to that side of things. Is that an area of growth still? And what could put a lid on it, I suppose, is what I'm interested in.
So absolutely to us it is. And the two main areas that we've been leaning into have been relative value, macro, and long-short hedge funds. We think that their ability to ebb and flex with this uniquely unpredictable environment makes a lot of sense as a cornerstone of portfolios. And then secondly, private infrastructure. I love some of the attributes of some of these private infrastructure strategies that we and some others invest in. To me, it is a very effective combination of three main things. Number one, bond-like consistency of cash flows, and everyone likes income for a degree of their portfolio. Number two, extremely low volatility. We've had a very smooth ride in the returns in some of these strategies. And number three, almost zero correlation whatsoever to broader public markets. So if you're focused on things such as what was just discussed in the prior segment, the level of JGBs, long-term yields, government debt themes, and things along those lines, these types of strategies can give you, again, bond-like returns, but are really on the side and allow you to sidestep any of those government debt concerns. So we think they make a lot of sense.
What limits your appetite for private infrastructure? What's the negative that we should watch out for? Because this seems to be a rich theme that many people have talked about for a long time.
Yeah, some people have concerns about the degree of liquidity or lack thereof. Some worry a little bit if it's gotten too much focus of an overall theme. Data centers, for example, an area that there is almost universal optimism and enthusiasm. Some people believe that it's got a tremendously long runway to run. Others believe that it's gotten a little bit, too heavily focused on. We focus on old-fashioned things such as ports, roads, bridges. We also have a strategy that we lean into for clients focused on long-term contracted shipping routes, so-called moving infrastructure. So not everything needs to be the AI data center theme. We have those. We think those make sense, but a diversified approach within the privates infrastructure asset class, we think can serve portfolio as well.
Eric, great to catch up. Thanks for stopping by to see us. Really appreciate it. Eric Waitlist, EMEA Head of Investment Strategy at JP Morgan Private Bank. Call 6 looks like this morning. Let's take a look at what we are seeing in the numbers. Fairly mixed and going nowhere in a hurry seems to be the overall story. A little sell-off into the safety trade at the right-hand side with Nestle down a little bit. But I'm not sure any of these numbers give you a real clue and a real kind of macro read as to what is happening out there. Let's talk about some other stocks that might, though, and some single stock stories that are interesting from a CEO point of view. Joe, what do you got?
So one stock that is going nowhere in a hurry currently, Guy, is Soitec, but that is because we are in a volatility hole on that one. We are unchanged on that, but that is purely because there's too much volatility coming into that stock. So they can't actually open it in Paris at the moment, but we are seeing calls lower in the pre-market indications, down around 15% on that one when I stepped away from my desk. Keep an eye on the price on that one. Then in terms of the CEO news, Stellantis, edging very slightly higher. That one is down around 50% on a 2-year basis. So they've got the new CEO coming in, a lot of experience in the US. As Anna mentioned, if you've got a US experience on your LinkedIn, you are likely to get a CEO position, according to the statements we've seen today, at least. Stellantis coming up very slightly. Antonio Filosa coming in as new CEO on that one. Then we've got Remy Cointreau. Not so much of a positive reaction on that one, but it is a new CEO at the drinks maker, another stock down sharply, and we're not seeing much of a reprieve for this one. Now, again, it is an internal appointment with some US experience at least coming in for that one in terms of Remy. That one might not be internal. I think that was actually the Stellantis one. Too many CEO changes to keep notes of, but the important thing, Remy shares are lower at the moment. Then we've got Kingfisher over in DIY. It is the owner of B&Q here in the UK, of course, but actually the weakness not in the UK, it's Poland that is weak, and also France not looking good in terms of the construction sales for that one. So Kingfisher, a bit weak. The international sales weighing on that one once again. It's been a bad run for Kingfisher shares. Then in terms of share sales, we've got a lot came through last night. We had a big flurry of them. Galderma, that is in the cosmetic space, a big one in them. In Switzerland, it was around 1.5 billion euros, I believe, in that one. Ferrovial in construction over in Spain, and also Strabag in Austria, construction as well. Share placings, people offloading stock following rebounds in some of those shares. Keep an eye on those. Then finally, to finish on L'Oreal, because JP Morgan warning in a note that the beauty market is weakening in both Europe and in the US. So they reckon that cosmetic sales, makeup sales, that kind of thing is going to continue to slide, and therefore they're putting this one on a negative watch, and we're seeing L'Oreal coming down more than 1%. Over in France this morning, L'Oreal is a negative view at JP Morgan today.
Joe, thank you very much. Yes, you're right, Frank. Marie-Lee at Remy Cointreau, the new hire there, is an external hire and taps into the story that Joe was just talking about there. Actually, his most recent position was at the Japanese cosmetics maker Shiseido, which he left just a little while ago. So we'll continue to focus on some of these new CEO appointments across Europe. Also coming up, another delay for BBVA's bid for rival Banco Sabadell as the Spanish government decides to conduct its own review of the proposed takeover. We're live in Madrid with the latest. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. About 19 minutes into today's session. Seeing some green on the screen here. Outperformance when it comes to the FTSE 100, but not by much. So we're going to keep an eye on that, see whether or not the green on the screen actually holds. In the meantime, a couple of individual stories we want to bring to your attention, starting off in Spain, where the Spanish government has decided to conduct its own review of BBVA's takeover bid for rival Sabadell. It marks the latest chapter in the ongoing saga to unite 2 of the country's largest banks. Bloomberg's Macarena Munoz joins us from Madrid with some of the details. Macarena, walk us through what the government can actually do from here.
Hi. So the antitrust watchdog approved BBVA offer last month with some conditions, and now it's the government who says that it wants to carry on its own review, claiming reasons of general interest. That would mean it will now have 30 days to study the proposal and could impose tougher conditions and even stop a legal merger.
Okay, in terms of how this is going to impact the deal, could this derail the deal? Could BBVA decide to walk away? What is the next thing that happens here?
Yes, so indeed, if the rationale of the merger changes due to the tougher conditions, BBVA could decide to walk away. But so far, the bank says that the merger makes sense and that it sticks to the proposal.
Okay, thank you very much. Bloomberg's Macarena Munoz in Madrid talking to us about the latest in that bid battle within the Spanish banking sector. Another theme of this morning has been CEO changes. Let's have a quick look at Remy Cointreau and how the share price is responding there. We were just talking earlier on with Joe Easton about how this is an external hire to Remy, somebody coming in with a lot of experience in various sectors. He's been at Unilever, he's been at Shiseido, the Japanese skincare company. He's been across a host of different sectors, and that stock, though, down by 1.2% right now. Another CEO we're focused on, Stellantis, also has a new CEO. The car maker appointing its America's head, Antonia Filosa, to the role. Bloomberg's Caroline Conan has more from Paris. Caroline.
It took more than 4 months for Stellantis to replace Carlos Tavares, who was ousted in December after 10 years at the helm of Stellantis. And Bloomberg had reported that Antonio Filosa, the current head of Stellantis in North America, had been the top contender. And clearly, this is sending a huge message to the US. He is described as the anti-Tavares. He started his career at Fiat 25 years ago. He was a protege of the late former Fiat CEO Sergio Marchionne. And clearly, Tavares had huge clashes recently with the United States, with unions, with car dealers, with politicians about how Stellantis is handling their brands in the US. You know, they own Jeep, they own Ram, Dodge, and Chrysler, of course, and they've been accused there of not reviving fast enough the portfolio of these brands and really losing market share in the US. So we'll see if Antonio Filosa reassures investors, especially on the US markets. Of course, there is the uncertainty about Trump's trade policies, because even though Stellantis has a lot of production lines in the United States, they import a lot of car parts from Canada, from Mexico. And in fact, they recently said that they were withdrawing, kind of suspending their guidance for the rest of the year due to the uncertainty about all these tariffs. They even at some point considered moving some production from China to Europe in order to avoid the potential US tariffs on China. The North America deliveries of Stellantis fell 20% in the first quarter, and the market cap of Stellantis has shrunk about 2/3 since the peak in March last year. So we'll see if Antonio Filosa can reassure investors, especially reviving the relationships with the US market.
Yeah. A protege of Sergio Marchionne. That's all you need to know. Caroline, great stuff. Thank you very much indeed. Caroline Conan joining us out of Paris. Let's stay with the auto sector. Bloomberg has learned that the troubled Japanese automaker Nissan is seeking to raise more than $7 billion from debt and asset sales to keep operations on track amid huge loan repayments that are going to hit next year. Let's bring in Bloomberg's Danny Lee on how they are going to achieve this. What do we know about how this is going to work, this financial engineering?
Yeah, Guy, this is going to come from a mixture of debt and asset sales, and it speaks to the real urgency that a new CEO, Ivan Espinosa, is looking to raise money and sell down on assets because of this huge debt wall that is coming next year. And given he's been recently installed, he's been taking a close look at the books and just to see how healthy or unhealthy the financial situation is, right? And so in terms of some of the numbers, Nissan is trying to raise $630 billion from convertible securities and bonds, including from the high-yielding US dollar and euro notes, and also looking to sell and lease back the headquarters particularly, and also to pare down some of its stakes in such as Renault as well. So there's a lot it's trying to think about in terms of trying to stabilize that financial ship in order to try and look ahead and trying to ensure that it does survive in the short to medium term.
All right, Bloomberg's Danny Lee walking us through the Nissan story. We thank you so much for that crucial context. As Danny was speaking, we did get some headlines in the banking sector, this time coming out of UniCredit, talking about, again, yet another consolidation story, raising their stake to 20% in Alpha Bank. This is, of course, the Greek bank that they've had their eye on for quite some time. They're also asking for regulatory approval to pull that stake up from 20% to 29.9%. The share's rallying, it seems, off those headlines, Anna.
Okay, so we focus on the banking sector. Also in retail, interesting that Reuters is reporting that Shein, the fast fashion brand, is planning a Hong Kong listing after its proposed IPO. We talked about this many, many months ago in London, had failed to secure the okay from Chinese regulators. So there's not so much about UK approval for any IPO in London, but about the Chinese stance. And of course, in the background to all of this, Guy, we know that the US is taking action on the de minimis rules, and lots of other G7 finance ministers have seen a sort of door opening, a way that they can try and tap into those kind of flows as well.
Absolutely. And UK retail, European retail has been pushing for this for quite some time. This has obviously been a huge headwind for retailers here in Europe and elsewhere around the world, and it looks like we're going to see some significant changes. But as you say, this is probably largely regulated out of the Chinese story. That seems to be where the impetus seems to be coming from here. Up next, we are going to turn to how private equity is viewing Europe. We are going to be joined by KKR's EMEA co-heads joining us around the table next. Looking forward to this conversation. It is coming up next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into today's session. And will I go so far as to say this looks like a better session than maybe an hour ago we were expecting? I mean, it's all marginal, but we're up by 0.3% on the German DAX. The French market not doing too badly. Overall, though, pretty flat across European equity markets. US futures then pointing just a little bit lower, Critty. It seems that Monday's excitement is a long time ago. That was joined yesterday with excitement about the US consumer. But today is a new day.
A little bit of optimism around America, it seems like. We'll take a reprieve when we get it. Let's talk about that theme, though, and how it translates from the public markets to the private markets. Last week, we had a conversation with the chair of EQT, Connie Johnson, about how the Swedish giant is positioned to benefit from that trade-off. Take a listen to what he had to say.
The ones we're competing with is almost exclusively the US firms right now. And they are having some headwinds out in the world for reasons caused by others than themselves. And the flip side of that is that people are looking more for managers that are not based in the US, and maybe to deploy money with GPs that is not US based or US dollar denominated.
Connie Johnson, EQT founder and chairman there, of course, talking there about how that American exceptionalism trade, or lack thereof, is actually helping them operate more in Europe. So I want to expand on that theme and bring in Tara Davies and Mattia Caprioli, co-heads of KKR's EMEA operation, joining us around the table this morning for a conversation on that topic. Thank you both so much for your time. Mattia, I want to come to you initially and talk about that trade-off, because we talk about it so much in the public markets. The volatility emanating from the States means that the Europe bull case is kind of a no-brainer. To what extent is that showing up in the private markets?
Well, thank you for having us, first of all, Kriti. Great to be here. I would say, look, there's certainly a lot of volatility and uncertainty out there, and we're all affected by it. But we're seeing some positive signs in Europe, as Connie Johnson mentioned. Certainly, the Draghi report highlighted some areas where Europe could do a better job at regaining competitiveness. And we've seen what Germany has done with a significant shift in terms of their fiscal policy. They've announced 500 billion of capital being invested in the next several years. That's a significant contribution to GDP. And so we see a renaissance of Europe at the higher level with some positive trends that will help our asset class, our private capital. So we can play a role deploying capital in partnership with founders, entrepreneurs, governments. We've done a lot of that through our infrastructure and private equity businesses, and that can clearly help Europe regain competitiveness in a number of areas.
So Tara, weigh in here, because you, of course, have a specialty in infrastructure as well when it comes to kind of a bit of a division of responsibilities. He mentioned there that massive fiscal spend from Germany. I imagine you're in conversations with some of the leaders of Europe. There is a question, though, of how long that lasts, how quickly that kind of infrastructure spend can come to fruition. What is your view on that at a time when not just KKR, but private equity in general is flocking to the infrastructure deals?
Yeah, so it's actually quite interesting, because if you think about half the world going to election last year, actually what we're seeing is political cycles are actually much shorter than the duration of our capital. And in the infrastructure space, you actually have to be very patient. But I think, it's good news about the $500 billion spend in Germany, and governments are actively talking to us more than ever. And if you think about this cycle relative to the global financial crisis, in the global financial crisis, debt sat with the consumer. In this cycle, actually, debt sits with governments. And so governments more than ever need to partner with private capital to help deliver their infrastructure solutions.
Yeah, Tara, so I imagine there's a lot of open doors when you're going through with money to spend, and governments are finding their hands are tied, and they're looking for co-investment and other people to play a role. We were talking earlier to an investor who was talking about the big appetite that investors have for putting money to work in private markets and talking about infrastructure. But he was careful to divide it up into different types and say, maybe some areas of infrastructure, there are just too many people who just think everything's wonderful, like data centers, for example. And maybe on the other side, he was saying they're focused more on ports, bridges, roads, that sort of thing. Where are the biggest opportunities in infrastructure?
So I've been investing in infrastructure for the past 25 years, and the tailwinds couldn't be stronger. And two key areas where those tailwinds are really strong are energy security and digitization. And to your point on digitization, I think, if you look at the spend that's required to 2028 in fiber, towers, data centers, it's $3 trillion of capex globally. So that is a multi-generation kind of trend that, we can invest behind as infrastructure investors.
Mattia, we have been talking a lot about, doors open maybe to private equity money. Governments very happy to have conversations about where that money can be usefully put to work in Europe and elsewhere, no doubt. But there are other conversations that happen around private equity, and you guys have been bidding for a lot of UK assets, and other private equity businesses bidding for a lot of UK assets. And that leads to some people saying, what's wrong with the UK listed markets? Why can't they be more resilient in the face of foreign takeover, private equity approaches? Is that something we should worry about or not?
Well, as mentioned earlier, having private capital as an enabler of growth and economic development is a positive trend. By the way, what we do is not just taking companies private. We invest a lot in partnership deals. Europe has a lot of family-owned businesses, even relative to other markets like the US. The breadth and the depth of family-owned businesses in Europe is significant, and a lot of these entrepreneurs often seek capital to take the company to the next level, to grow their businesses internationally, to buy other companies, consolidate fragmented markets, and that's where we come in, providing that capital and our operational capabilities and our global resources that enable those founders and entrepreneurs to expand their companies. This is not just valid in the UK. Across Europe, we see that trend continuing, and we do support the European renaissance through our capital in a lot of what we do.
What does Europe need to do to be better at this? What do we need to do in Europe to get better at attracting money to invest in our kits, our infrastructure, our markets? You talk about the Draghi report. Does it go far enough? If you guys look at the barriers that you face right now here, what are the most significant ones, and what do you think the easiest ones are to overcome?
Look, I think investing at the end of the day is about people. So, and Europe, unlike the US, is very nuanced with lots of different jurisdictions, lots of different cultures. So you really do need to be local in the markets you operate to kind of navigate political landscapes, regulatory landscapes.
But the idea is that Europe's meant to provide some degree of commonality. That's the idea of a single market. That's the idea of single regulation. That's what Draghi's talking about. You talk about the fact that there's lots of different jurisdictions. The idea is we want to get rid of some of that. So how big an impediment is that, say, versus investing in the United States currently?
So I think in Europe there is a higher regulatory kind of hurdle when investing,
Right.
and I think investors are attuned to that. But that is the framework in which we're navigating on a day-to-day basis. I don't know whether Mattia had a...
I would add that the Draghi report points to a highly fragmented market in Europe across everything pretty much, and talks about consolidation at the corporate level, consolidation by sector, and also getting the European Union more integrated in taking decisions and actions, not as individual countries, but much more as an entity. So that's an opportunity for us, because a lot of what we do with our capital is to support businesses consolidate their sectors, either within countries or across Europe. And so, part of our opportunity set in Europe is really provide that capital for consolidation, for investment in digitization, in energy transition, in infrastructure, and a lot of the themes that we invest behind.
How much faith do you have that things are going to change?
We've been doing this now for almost 3 decades in Europe to really help businesses consolidate. We've done it more on a niche scale historically, and now with a call to action and some of the responses that the European countries are having, we feel that could be amplified even further. There's going to be much more of an acute effort to consolidate industries across Europe and leverage private capital to do that as well.
Well, talking about that private leverage, then, this is the perfect time to talk about the capital markets. 2025 was supposed to be the year of IPOs re-emerging, all these take privates to finally kind of get out of this deal glut. And that's not happening. And it feels like it's because of the volatility. But how does that square with maybe some of the other liquidation of assets you're seeing from endowments, but from other long duration asset holders? Are you worried about too much of a deal glut?
So look, when we step back and we look at and everybody talks about monetizations and how IPO markets affect monetizations in private markets. When we look back and look at our history of monetizations, IPOs have been a very small part of our monetizations opportunities. Most of our exits have been to other financial investors and or strategic investors, corporates. And so we don't necessarily rely on IPOs and liquid markets too much as an industry and as KKR to monetize our investments. And so there is a hope that capital markets in Europe will consolidate at some point, the banking union, the capital markets union.
What's your timeline on that?
At some point.
At some point.
How long do we wait for that to happen?
I'm hopeful that with some of the calls to actions that we've talked about and some of the talks and reactions that governments are having, the U-turn in Germany, there's going to be a more concrete effort to make some changes at the European level to drive a more integrated capital markets and or banking market.
So what is that doing to valuations then? If you start to see, let's say the capital markets on pause for a second. We had Lynn Martin talk to Bloomberg in the last 24 hours talking about that even for the New York Stock Exchange, the most liquid capital market in the world, they're not even looking at IPOs until the back half of next year, if not further along, in terms of really getting that fund flow going. What does that do to valuations when you're trying to scoop up new deals? Does that bring valuations down because people maybe don't want to be holding assets that long?
Well, we are long-term investors, and we think about the potential of the business to compound earnings over 5, 10 years, 15 years plus. And so the valuation question is really down to risk returns and how much you can change and improve a business from an earnings standpoint.
Does it change sectorally, though, with an AI story, for example? Are AI private valuations following AI public valuations?
So absolutely. So every sector has its own earnings momentum or earnings power, and therefore attracts a different valuation. If you look at our portfolio in Europe in private equity over the last year, it grew earnings by 18%. And so our concept of valuation is obviously relative to the ability to continue driving growth in our portfolio. And over time, we've always solved for similar returns and similar risk returns. We do not expect valuations to improve over our investment cycle. And so, yes, there is an opportunity to invest in certain assets at the moment because of the volatility at more attractive prices, but it's down to that risk-return equation that doesn't change significantly over time.
Now it falls to me to ask about one particular investment that you're trying to make at the moment in the regulated water sector in the UK. And I don't know who's best positioned to comment on this. Maybe Tara, you have a go. I mean, we've been reporting a lot on what you're looking to do with the existing creditors in your attempts to buy this business, and maybe you're limited in what you can say about that. But I wonder what your approach is with the regulator, with Ofwat. What are conversations like with the regulator at this point?
It's an exceptionally complex situation. You've got the environmental agencies, you've got the lenders, you've got government, you've got Ofwat. So there's a broad range of stakeholders there. I think if I take a step back, KKR is a top 3 infrastructure investor. We own 8 regulated assets in very different markets under very different regulation. And we've actually controlled the UK water company before. So, this is a situation we understand, but ultimately, we're talking about the hypothetical here because the stakeholders will decide what to do with Thames Water.
The stakeholders will decide, and you think that there's a role for KKR, that this type of business can work under a KKR umbrella?
It's an infrastructure business of a similar nature to what we've actually owned before.
How does infrastructure investment change over the next years? You've got underinvested spaces like Thames Water, which now need heavy investment. You've just had a huge outage in Spain and Portugal. Massive changes taking place in the way that big infrastructure grids are managed. You talk about how the stakeholders are going to be involved in this process. Is it becoming more complicated to navigate some of these spaces at the moment, given the need for change, the need for investments, new technology coming in, new priorities with the green agenda being emphasized as well? You talk about the fact that you've run these kind of businesses before. Is running these businesses more complicated now than it was?
Look, I think with complexity in the market, there definitely comes opportunity. And I talked about energy transition and digitization as themes. Now, they are actually interwoven now.
Sure.
With energy being required for data center growth, for example. And so you can see those two themes merging together. But if you look at grid capacity and what's required there, they are actually quite simple investments.
Right.
And we just made an investment in the US with American Electric Power. Interestingly, that's a $54 billion market cap, but its CapEx profile is also $54 billion.
Okay.
And so this is where private capital can help at points in time where there's these large humps of CapEx to, help deliver what people need.
Globally, how much? Just give me a sense of the scale of what we're talking about globally. We're going through huge transitions at the moment in numbers of different spaces. Do we have enough? How do governments do it? How do you do it? Do you have enough? How much capital is there required out there to make these changes? And is it going to be capital constrained?
If we look at digital, it's $3 trillion in the next 3 years. So it is a capital constrained space.
Yeah.
And I think that evolution means that it will take longer than what people expect.
Okay, that's where I thought we might be.
Tara, Mattia, I'm going to give you the final word on this. What do you need to continue to be bullish on Europe? Tara, I'll start with you. From the regulators, from the likes of Emmanuel Macron, Friedrich Merz, et cetera, what do you need to get really going in Europe?
Look, I think when we think about what makes our business really important, it's teams on the ground and people with aspiration wanting to do good things.
What about you, Mattia? If you had a wish list for the regulators, for the European leaders, a magic wand, what would you ask for?
Well, I think we've got a lot of the ingredients we need to be successful in Europe. We've seen our momentum increasing significantly. If you think about the volatility of this year, we've invested $30 billion globally, a lot of that outside of the U.S. We've committed since Liberation Day $10 billion in Europe specifically. And so we see the momentum being very strong, and we think these are the prerequisites for us to be successful over the next 5-10 years.
From the governments, you're all set?
We are pretty positive that the governments are doing the right things to make us successful in Europe.
Fair enough. Co-heads of KKR, EMEA, Tara Davies and Mattia Caprioli, joining us around the table to talk about just how the private equity market is faring in Europe.
Yeah, and talking about that data center story, we're going to focus on it next. We're going to be talking about what we're going to see in NVIDIA's numbers coming out a little bit later today after the bell in the United States. What are they going to say about AI demand, data center demand? We're going to get the details of that story next. This is Bloomberg.
we're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Welcome back. It's Wednesday the 28th. Just had to check. We are, 50 minutes into the equity market session thus far. Equities look like this. We're a little higher than when we first started out this morning, first thing. So we're up by, let's call it 0.2, 0.3 of 1% in Europe. US futures have been sort of gently rolling over. They're not down by much. I don't think there's a lot to see there in terms of the narrative. Bond markets a little on offer this morning, so yields are going higher. Apparently we're all supposed to be paying attention to a Japanese 40-year. Never talked about a Japanese 40-year before, but now it's a story that we should all be focusing on.
Absolutely it is. And Guy keeps trying to write off May. There are still days of May. It's May all this week. I'll just point that out for Guy so he doesn't get confused.
Monday is the first.
There we go.
I know
Monday
that.
You can move on. We can all be in June by then. Let's have a look at what's lies ahead for us when it comes to the events on the calendar. OPEC Plus ministers at OPEC Plus are holding a virtual meeting today, so that could be interesting. We're watching for what decisions that grouping is going to make in the near term around production. Will we see a 411,000 barrel increase? President Zelensky is going to be in Berlin. We talked earlier on in the program, and we'll get to that in a moment. We also get FOMC minutes, lest we forget about that. And we have NVIDIA numbers out later on today. Let's turn to that topic, shall we? When it comes to equity markets, the next big catalyst, could it be the numbers out of NVIDIA? First quarter earnings report coming through after the US bell. So we've got to go all the way through a US session, which looks flat to negative before we get there. Now, the last of the Magnificent Seven companies to report, really the final word on whether the stock markets had a good quarter or not, and what could set the tone for Wall Street heading into June. Joining us now, Matt Bloxham, who leads our tech coverage in London for Bloomberg Intelligence and is on set with us right now. Matt, talk us through your thoughts. Is NVIDIA weathering the storm?
Yeah, I think they are. I think obviously it's had a bit of a wobble for a couple of quarters, but demand from the hyperscalers is robust. They had some supply issues with the Blackwell chips, which is the next generation of chips, but a lot of those have been resolved now, and the market's looking for them to kind of ramp supply of that, and they can't make enough of them for the US hyperscalers. So I think generally speaking, people are looking for encouraging signs, both for the quarter that's just finished and also for the next quarter to ahead. Obviously, there are worries about the indirect effects of tariffs on the company, but that's going to kind of crimp demand a bit. But I think there's enough structural demand coming for the next year or two that they should be able to sell through that. Obviously, China is a big focus. They took a $5.5 billion write-down because of the latest constraints on the H20 chips. They basically can't sell into China. Our estimates are that could cost them about $15 billion in revenue for fiscal 26, which is about 7 or 8% of total sales. So it's not insignificant, but I think that the ramp in Blackwell demand will counter that.
What matters more, the trade war with China, those export controls, or the AI momentum?
I think the AI momentum, for sure. I think most analysts would think that over time, a bit like we've seen with Apple, China's going to fade in terms of significance because they have their own China-centric AI agenda. So I think it's really the kind of ex-China AI demand that's more important, and that's where all this kind of story about Middle East demand and sovereign AI infrastructure could be really important for them. Talk of the UAE buying 500,000 NVIDIA chips a year, which could be $10 to $15 billion of annual revenue, which again, kind of up in that kind of 7-8% of sales. So kind of helpful growth if the hyperscaler demand starts to tail off. You've got that second structural tailwind coming through.
Average for the year, 125. What are we trading? 135 now. Low 94. We're above the average. Does that mean the glass is half full? Are we looking for good news rather than bad news? We'll find out a little bit later. Matt, thank you very much indeed. Matt Bloxham joining us from Bloomberg Intelligence. And do not miss Bloomberg Technology special coverage of those NVIDIA earnings. We're going to get live reaction to the figures from the CEO. Jensen Huang is going to be joining us a little bit later on. We are obviously going to be hearing him speak as well to investors and analysts. All of this coming up at 11:30 p.m. UK time. What else do we need to know this morning? Let's talk about what is happening in Berlin today. Bloomberg has learned that Ukrainian President Volodymyr Zelensky is set to travel to the German capital for talks with Friedrich Merz today. This obviously follows news about long-range missiles that has come over the last couple of days. Bloomberg's Ollie Crook joins us from the German capital. Ollie, we are hearing growing criticism from the White House of Moscow's actions. There is talk of sanctions, but the question we're now wondering is, does it turn into military hardware? How does what happens today in Berlin alter, influence what is going on with the resupply of Ukraine? Put it all together for me.
Yeah, well, I think that Zelensky will come here to try to find out in some sense what kind of ally he has in Friedrich Merz, who has been a much more sort of hawkish voice in terms of supporting Ukraine than his predecessor Olaf Scholz. Olaf Scholz, who also was a very strong defender of Ukraine, but was very sort of reticent about sending long-range missiles, giving permission, sending tanks, was always a step behind the Americans, basically waiting for Biden to do something and then coming into the fold. Friedrich Merz has really cast himself as somebody who's going to be much more active, much more proactive in terms of supporting Ukraine with these Taurus missiles. There has been a bit of controversy over that over the last couple of days. He was sort of making some very ambiguous statements, not clear whether or not Germany will actually deliver those missiles to the Ukrainians, whether or not, and these are missiles, by the way, that were so sort of fraught as a military issue because they can strike basically Moscow, theoretically, from within Ukraine, which is why Olaf Scholz didn't want to deliver them. So today what we will find out is what kind of ally Friedrich Merz is going to be for Zelensky at a moment when, as we know, the U.S. administration is stepping back ahead of this summer potential offensive by the Russians. We have Russian troops that are amassing more and more on the Ukrainian border. And at the end of the day, there needs to be an anchor that holds down the foundation of support for Ukraine. In the absence of the United States, will that be Germany? And, Friedrich Merz really wants to turn Germany into a military sort of powerhouse. Yep. And that is going to be the conversation that is held between Zelensky and Merz today.
We'll look forward to the coverage a little bit later on. Bloomberg's Ollie Crook joining us in Berlin. That wraps things up.
It does.
We work our way through into. I think it's going to be an interesting session. I have a sort of. I'm wondering.
Your spidey senses are tingling.
Well, no, I think there are interesting things that people can't quite figure out what's going on, and that always you either sit there and you wait.
Yeah.
But are we going to see a catalog? The FOMC minutes, I think, could be worth paying attention to. There's various things coming up. Anyway, the Pulse is next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is
indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Donald Trump steps up the battle against Harvard, ordering the cancellation of $100 million worth of federal contracts and pausing foreign student visa applications. NVIDIA to report earnings that will give a sense of whether demand in the U.S. can outweigh restrictions on export to China. Well, the chief executive joins Bloomberg this evening. Plus, Stellantis names its head of American operations as its new chief executive. Antonio Filosa now faces the task of turning around the car maker. Now, there's quite a lot going on. Certainly, there's a lot going on when it comes to markets. The focus yesterday firmly on bonds. Today we stay with bonds, but also looking at stocks. Now, stocks definitely pausing some of their advance. Bonds retreating due to concerns about the U.S. economy. We do have a couple of data points that we need to keep an eye on. There's also still uncertainty, not only over tariffs, trade, but also the nation's fiscal positions. Now, investors remain wary of the economic prospects, basically, of the U.S. after Trump's inflation of trade war and pursuit of deficit-raising tax cuts is putting a little bit of alarm bells in certain parts of the market. Euro dollar 113.28. Look, we look at the Japan 10-year yield just because of the swings that we saw yesterday with, of course, the BOJ. We look to a lot of central banks that will have decisions in the next couple of days and weeks, and then the 10-year yield in the U.S. 4.463. Actually, 4.634. I can't talk. It's a Wednesday that feels like a Monday. Let's take a look at the European markets map again. A little bit of, tentativeness out there. UK stocks getting some 0.2% and similar gains across the board. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in a moment, we'll discuss the impact of U.S. tariffs on Europe. We'll talk central banks, European banking regulation with Lorenzo Vinismaghi, the chairman of Societe Generale. But first, the latest on the Trump administration's ongoing battle with universities. The Secretary of State, Marco Rubio, has now ordered U.S. embassies worldwide to stop scheduling interviews for student visas. Now, the move ramps up President Trump's feud with higher education, which first centered on elite schools like Harvard and Columbia over anti-Semitism. Let's get more with Rosalind Matheson, our AMEA news director. Ros, thank you for joining us. This feels like a big escalation because it goes, first of all, right to the heart of what we thought America did best, which is university. And, the Trump administration just won't let go.
Well, that's right. So it's interesting to see, like, a lot of the focus had been on Harvard and Columbia and, you know, the top shelf universities, Cornell, Northwestern. This seems to be really sprawling out across that whole layer of US universities and saying, you know, of the 1 million plus foreign students who come to the US, they're now going to face even tougher vetting. I mean, the vetting is already pretty stringent, but now they're going to add this element of real scrutiny of social media onto that, and they've kept it vague enough to what does that mean? What are they looking for, and on what grounds might they rule you out? So it's again going to send that chill through the international student community. If you're thinking about your options about where to study university, does this give you further pause in terms of thinking, is there any guarantee if I get into the US, I'll be able to complete my degree in the US? And obviously it's not inexpensive to be an international full fee paying student in the US. It seems to be he's now like looking at the whole sector, and he's talking about trade schools, which is interesting. So is this about a certain tier of education in the US, a certain level of university, these venerable old institutions that are seen as elite universities, and pushing people more towards trade schools and money, he says, towards trade schools in the US? That's starting to emerge as a narrative, which is interesting, and that's much more about focusing money, as he would say, on US students in the US.
So interesting. Meanwhile, Elon Musk has also, Ross, expressed dissatisfaction with President Trump's giant tax bill, which the US House narrowly passed last week.
I was like disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Doge team is doing.
Rosa, I'm not sure about the relationship between Elon Musk and Donald Trump. I mean, he's not holding back.
Well, that's right. It's interesting because, of course, Trump has Musk as a key financial backer. And, you know, we're a couple of months in, but we're not that far out from the US midterm elections. And so keeping Musk on side in one way is important, but it's also for Donald Trump and for Republicans, keeping the US voters on side into the midterms is also important. So you've got those two imperatives with this bill in a way. Like, he needs these tax cuts to go through. And the question is, how much can you do on the spending side? You've got some Republicans saying that bill does not go far enough. You've got some saying, hang on, Medicaid, we're getting into territory here that's going to be difficult for us coming into the midterms. I mean, that bill's going to have a very interesting time in the Senate, to say the least. But in terms of Musk and Trump, I mean, Musk was saying you can have a big bill, a beautiful bill. You can't have both. And is he starting to show again that frustration with where his efforts on Doge? He's saying, well, has this actually achieved anything? It's interesting that they don't talk directly about each other. You're not seeing Donald Trump really comment very much of late on social media about Elon Musk, so perhaps the relationship is cooling a little bit, but not willing to go into outright direct criticism, because in a way they both still need each other.
Ross, thank you so much. Ross Matheson there with the very latest, of course, on the U.S. administration and Elon Musk. Now, the European Union is seeking to strengthen its common market in the face of rising geopolitical tensions and a growing trade conflict with the U.S. Policymakers are also touting the euro's global role as investors retreat from the dollar. Well, joining us now is Lorenzo Binismaghi. He's chairman of Société Générale and former ECB executive board member. So, Mr. Binismaghi, thank you so much, as always, for giving us a little bit of your busy schedule. I want to talk about inflation. I want to talk in general about the conundrum in which central banks are now. If you were still on the ECB Governing Council, what would you do? Is there room for more cuts, or would you pause and see what happens?
I think inflation is coming down, is well anchored. Expectations are well anchored. Prospects for growth are, weakening because of these trade wars. So I think interest rates can come down. I think the decision in next week is a done deal. The issue is, will there be further cuts? I think that's an issue for the fall.
But do you say, is there a worry actually that inflation persistently undershoots 2%?
Well, we will see what the forecasts are. They will provide forecasts. I saw the Commission and others looking at 2026, 2027 going 1.7%. There is a risk. In the end, at the end of this war and these tensions, will we go back to a world with excess savings like we had last decade? And in that case, you cannot leave it, happen too quickly. And let it go. You have to react quickly, and that may require some easing of monetary policy, maybe reflecting of what central banks did wrong last time, like negative rates, which were not very efficient, and a different maybe also quantitative easing, going back. That's a big issue. But for now, I think the prospects is just, looking at the next few months. I think the next week's cut is a done deal, I think.
I mean, you're very interesting because you understand monetary policy like few people do in Europe, but you also are chairman of Société Générale, so you have data, right? You have the data of loans and what businesses are doing. Is the economy in Europe in such bad shape that interest rates need to be below 1.75%?
The economy is holding, I would say. When we look at, from our point of view, the cost of risk is still very low. So, companies are doing relatively well, but you see some slowdown. And so the economy, monetary policy has to anticipate. They cannot just look at data today or tomorrow. You have to look at, and you need to dare making forecasts. And the forecasts going forward are not that great. If, China is slowing down, or at least it's not recovering that fast, and this trade war is going to lead to weaker growth over the next couple of years. So you cannot just wait for the data to come out and show the weakening.
What worries you the most about Europe right now, or global growth? Is it trade wars, or is it just this incapacity of getting out of some structural things? Like Europe, it has chances to seize the moment. Yes. I don't know whether this is one of them or whether it will squander it.
I mean, there is a demand in the rest of the world for Europe, for European assets, for European goods. It's up to Europe and to European countries largely to stand up to the challenge and continue the progress towards greater integration. Unfortunately, when you look at issues in some areas like the financial sector, you see some countries becoming more protective. And you see that in some of the banking issues. So this is a bit disappointing that we are not up to the challenge as Europeans, but I'm still confident the European Commission will try to re-energize and present some programs for simplifying regulation, trying to improve, eliminate barriers within Europe. That's the key issue.
So what are some of the, if you look at the ECB task force on regulatory simplification, which again is actually difficult to say, what specific issues do you want them to address?
Well, in fact, first you have to look at all regulation, overlappings, but more than it's not only about simplification. It's really, after 10 years of banking regulation, we should ask ourselves, does it make sense to have this kind of regulation? Because 10 years ago, these regulations, these Basel agreements were largely built on the post-Great Financial Crisis trauma. 10 years after, the world has changed. The non-regulated sector has grown enormously. It's a source of unknown risks. Risk management has improved. The world has changed. And I think it's time, like we used to do in monetary policy. Every 10 years, you put into question your monetary policy framework. I think there is a need for checkup also of the banking regulation. Does it make sense? And we should do this in Europe, not only looking at what the US do. We should do it just for our own interest. Does it make sense to have all this regulation about liquidity, for instance? This gold plating, these double calculations. So it's not only simplification, is really asking ourselves, the regulation we have put in place, does it serve the European economy?
But how can ECB, for example, supervisors maybe lighten the burden for banks to oversee some of the activities? That's at the end of the day, one of the biggest concerns from banks.
Yeah, you have the regulation and you have supervision. Yeah. In both areas, they have to ask themselves, are we efficient? Are we serving the economy? Are we making sure that, banks can do their job efficiently to support companies, to support households? And I think if they did that seriously, and if we do it together, actually, we can see that there are many areas where we can not only simplify, but make things more efficient. Lighten the burden that banks have in their day-to-day businesses.
What do you think of the EU delaying actually the implementation of these new bank trading rules? Is it a good decision? Was it the right thing to do?
Well, it's a good decision for the wrong reason, because we decide to delay this regulation because the Americans are delaying it. But, I mean, we should ask ourselves, this fundamental review of the trading book, does it make sense? Has anybody thought, 10 years after this Basel Agreement, does it make sense to have this kind of regulation for Europe in particular, where we need to build a capital market, where we need to have players, European players that are active in the market, and this regulation is actually penalizing in a very strange way, by the way. I think not many people really understand it. I wonder whether the regulators shouldn't give a new look at it.
Right.
Whether it makes sense for Europe to approve this regulation.
So even just the EU also opening its banking package, right? I know there's specific things that certain executives have said just make no sense. Is it scrapping the output floor, making phase-in period permanent? Like, is there something concretely that you would just change right now?
No,
I know there's also lighter capital treatment of some of the unrated corporates. Does that make just common sense?
There are so many things we have to look at. It's not an issue of deregulation, by the way. It's an issue of really efficiency of regulation and making the sector competitive and able to support the economy. I think giving a fresh look at each of the various areas. For instance, the Basel Agreement tried to discourage internal models. Yeah. So banks are trying to move back to standard models, but the regulator is preventing it to move back, and the supervisor is making it very difficult to go back to standards. Well, that should be welcome. It shouldn't be so complicated. So it's just the complexity of these rules that should be looked at with fresh eyes, with the idea not of deregulating, because that's not what we're asking, but to have more efficiency and to liberate, to free time for commercial, for making business in the sense of lending, rather than doing compliance and regulatory stuff.
Can I ask you something about the Trump tariffs? Do you see clients choosing European banks over U.S. ones because of what's going on, or is Société Générale benefiting?
Well, I think it has been a very good period for us. These markets. I think markets are realizing that we need investment banks in Europe. It's good to have diversity, but to have banks that follow you, are close to you during this period of time is very important. So this is an opportunity for European banks to strengthen their position in Europe. And it's an opportunity for regulators to help them strengthen this position in a competitive environment where we are at a disadvantage compared to the US, who benefit from this big market that they have at home. And we don't have yet an integrated banking market in Europe, and we see how this fragmentation is playing every day with new barriers, new. Let me not dwell too much on it, but it's a bit surprising that we say we want a single market, but then we found that savings is a national security issue. Apparently, we discovered that. Reading the newspapers.
Something that you don't agree with. Mr. Binismaghi, thank you for joining us today. That was Lorenzo Binismaghi, the chairman of Société Générale. Now, coming up, we'll digest what's going on in the markets. We'll be talking to Peter Oppenheimer from Goldman Sachs. That's next, and this is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Well, NVIDIA reports earnings later today, giving the market a highly anticipated update on AI demand amidst rising trade tensions. Our Charlie Wells is here with a preview. Charlie, it's going to be a big one. What are we expecting?
Good morning, Francine. So there is so much anticipation over these earnings, given the fact that the shares of NVIDIA have been on such a journey this year. You can see sort of a double dip year to date where we had those concerns about AI and then later in April, concerns about trade. And if you're paying attention to earnings today from NVIDIA, you really want to focus in on that trade issue, how China factors into the mix here, because Trump in April banned NVIDIA from selling its H2O chips to China. Jensen Huang, the CEO, has had some fighting words about that. And that is in large part because of how important China is to the revenue of this company. Now, there have been reports that NVIDIA could be selling lower price, lower power chips to China, and that could give a boost. That is a piece of information that analysts and investors are waiting to see if they hear more about, if they hear confirmation of those reports in this earnings call. But we know that there is a lot of cash on the sidelines. There is a lot of eager anticipation here. And we know that with NVIDIA, we are seeing a potential implied post-earnings price swing of 7%. You got a lot of cash parked on the sidelines, a lot at stake here.
Certainly, Charlie, thank you so much. Charlie Wells there with the very latest on NVIDIA. And I think we're also speaking to the NVIDIA chief executive a little bit later on this evening. Now, let's get into how the markets are pricing in EU-US trade tensions after President Trump announced an extension to the EU tariff deadline. Well, with us now, Peter Oppenheimer. He's chief global equity strategist at Goldman Sachs. Peter, as always, thank you for joining us. There's just a lot. There's a lot in the markets. There's a lot of volatility. They're up, they're down. It's kind of, sometimes there's appetites and there's a lot of things going on with bonds as well. What are clients generally telling you? What do they want to do with their portfolios?
Well, I think there are two questions that most investors are focused on at the moment. One is, where does the market go from here? And the other one is, what do you do in terms of asset allocation and geographical distribution? And I think on the first point, given the rally that we've seen from the low points just a few weeks ago, the risk reward is not that attractive. Valuations are back to where they were at the start of this year, even though where we're settling on tariffs is less good than people were hoping at the start of the year, and growth is slower. On the second point, I think there's growing appetite, particularly among global investors, to diversify more, to have a wider geographical spread. And that's a theme that we've been talking about for some time, given the concentration of most people's assets in dollars and dollar markets.
So you would diversify into where?
Well, I think there's different forms of diversification. Firstly, across asset classes. So we want to have a good spread across, with some actually an overweight in cash at the moment, equities and bonds as well. But within equities geographically, bear in mind at the start of this year, the US had the highest weight in the global index ever. And although that was justified given years of better earnings growth, we're starting to see more of convergence and therefore a more broad geographical spread. But I think also across sectors as well. It's not just about tech now. That was a sector that was really leading global equities for a decade and a half. And now we're starting to get a wider spread of opportunities. So we think by diversifying, investors will just get a better risk-adjusted return.
Peter, overall, I mean, there's a lot of competing forces, and I know it's also unclear where tariff ends up. So if you look at Europe, for example, are there opportunities if Europe seizes a moment, or does it look complicated just because it's in between U.S., China, and it seems that there's structural problems?
Yeah, I think there are structural problems, but they are well known about and reflected in valuations. I mean, if you look at the European equity markets, they trade with a valuation of about 14 times. That's not particularly cheap relative to its own history, but certainly very cheap relative to the US. There's a better prospect, I think, for rates to come down more quickly in Europe compared to the US. And we're also starting to see a shift in currencies. And when you look at things in a common currency basis in dollars, you're starting to get much better returns in European equities. And there are areas of growth, even in the value spaces, which were long neglected, which are looking more interesting to investors. And so I think there are selective and really interesting opportunities in Europe for global investors right now.
What are you expecting in terms of earnings per share and earnings in the next couple of quarters? And is it really different? Is it different depending on where you're headquartered? Does a UK-based company behave differently to a US one, to a German one?
Well, I think there are clearly sort of currency translation effects that are increasingly going to have an impact on earnings. Given the likely probability that the dollar continues to moderate against both sterling and the euro. But I think that we're still going to see relatively weak profit growth on both sides of the Atlantic this year, but most likely avoiding recession. And when you think about the prospects for easing monetary policy and fiscal policy at the margin across Europe and those cheaper valuations, I think that there's growing opportunities for investors who may have been neglecting it because there was so much activity happening in the US itself. And although the US market offers selectively very interesting opportunities, we think even within that market, investors should be broadening their exposure across different sectors and not focusing purely on the biggest tech stocks, which have been the dominant drivers for the last few years.
Peter, I mean, there's so much focus on private companies, right? I mean, again, the money, deploying money or, putting capital to work, you have a lot more options than you did 15 years ago, 15, 20 years ago. Does that complicate, actually, the equity space?
Well, in a way, it provides another opportunity for diversification because people are diversifying not just across asset classes and geographies, but across public and private markets. And I think that's a good thing because it gives people a broader set of different types of assets and different structures. And I think that private markets are going to continue to grow significantly. And the opportunities to scale and grow businesses in the private markets and keep them private for longer is clearly still very much in the fore. And I think you're seeing a growing institutionalization of those markets, which are becoming very attractive.
On tech companies, I know you mentioned it, but how is it too soon to find winners, actually? Because it seems, everything's changing very fast.
It is. I think what's happening there, again, is a broadening because the dominant tech stocks, largely in the US, had such strong competitive moats and was so dominant in terms of overall profits in that industry that it is beginning to widen out. Clearly, there's more competition coming. We've seen that in China already this year and in other places. And I think that's a good thing because it's going to accelerate adoption and take up of new technologies like AI and create the platform for new products and services to emerge that leverage off these foundational models. And I think, again, that tells us that there are good growth opportunities in the tech space, but they're likely to broaden out and provide better opportunities across a broader range of assets.
Peter, thank you so much, as always. Peter Oppenheimer there of Goldman Sachs, also author of Any Happy Returns. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump steps up the battle against Harvard, ordering the cancellation of $100 million worth of federal contracts and pausing foreign student visa applications. NVIDIA to report earnings that will give a sense of whether demand in the U.S. can outweigh restrictions on exports to China. The chief executive joins Bloomberg this evening. Plus, Stellantis names the head of its American operations, and its new chief executive, Antonio Filosa, now faces the task of turning the car maker around. Now, the head of UBS's Asia-Pacific operation says customers are increasingly turning to alternative investments as they navigate increased volatility. Well, Iqbal Khan also said he's expecting interest rates to come down, and he still sees a potential for stagflation. Well, he's been speaking exclusively to Bloomberg's David Inglis.
While risk has come down, there is a continued potential of stagflation. However, things have moved on. And I think one of the calls we made early on, and actually already coming into this year, around diversification and diversifying across geographies, currencies, sectors, has worked out really well. So diversification it is, and diversification remains a key theme for investors and for building better investment portfolios.
Yeah, and I think certainly with the facade of U.S. exceptionalism starting to go away, you are getting more portfolio flows coming out. What are you seeing as far as wealth flows are concerned, to the point you're making on needing to diversify, especially now?
Look, clients are looking at this world coming into 2025 and seeing that having a more diversified portfolio, thinking about how you allocate capital in different currencies, different sectors, but of course regionally as well. Look at the European indices, look at Hang Seng just here in Hong Kong. Yeah. You look at these indices, you are clearly, if you're thinking about the equity space, think about diversification, think about the bond market as much as, of course, alternatives. So fundamentally, we've been very much focused on helping our clients invest on a diversified basis, and I think that's working quite well. At the end of the day, in an environment with a lot of volatility and uncertainty, while we have a pause around tariffs at this point in time, there will be continued volatility. We expect continued volatility. And in that perspective, I think being diversified, thinking in scenarios, that is absolutely key. And that's what we're helping our clients think through, work through, and help them invest accordingly.
Is the assumption for rates still to go down?
Well, look, I think we are starting to see inflation numbers come down to some extent, right? Having said that, there clearly is a perspective of timing around rates. We do continue to expect that rates will come down. It's a question of time, and of course, as we see further data come out. And also, just let's not forget the uncertainty we still have around tariffs and the environment itself. So I do feel that while we will see rates come down, it's a question of timing.
Right. And it's puzzling to us sometimes. To your point, you look at the equity benchmarks in Europe, you look at here in Hong Kong, it's as if nothing happened in April. You know, we're back to those levels before those Liberation Day announcements were made, and even more. But the bond markets seem to be dancing to a separate tune. We seem to be getting higher and higher yields on the long end. Which asset should I believe?
So look, I think what is interesting clearly is after some of the adjustments and some of the events that we saw earlier this year, even S&P is at more than 5,900, so actually higher than when we started this year. And yes, absolutely, European equity markets as well as Hang Seng are doing quite well. In the bond market, or overall long-term rates, of course, are impacted by fiscal policy and of course also what is to come, specifically in the U.S. when it comes to the U.S. budget and anything around deficit, and the overall plan that is to be implemented. I think you're seeing that impact more on the longer rate curve.
Our exclusive conversation right there with the UBS APAC President Iqbal Khan. Now, Donald Trump's efforts to remake global trade and the U.S. economy have brought uncertainty to global markets, sell-off in the dollar, and turmoil to bond markets. Well, Trump's foreign policy moves have also shifted the geopolitical landscape. So how should investors and business leaders hedge against all of this? With us now, Dambisa Moyo, principal at Versaka Investments. She also serves on numerous boards, is a member of the UK House of Lords, and the author of 4 best-selling books. Dambisa, first of all, congratulations, frankly, on everything you do. But look, when you look at bonds, and you know, we've spent a lot of time over the last couple of weeks trying to figure out exactly what's priced in, what's not priced in. But also, do you worry about, first, you know, the correlation between equities and bonds, and just what, you know, treasuries mean for investment and growth?
Well, so thank you for having me. The fundamental point, I believe, is that we're in much more uncertainty than had even been anticipated. I mean, Peter, who was on here a moment ago from Goldman, was talking a lot about what's priced in and what's not priced in, and clearly there's a lot that has not been priced in. I would say the uncertainty can be broken down into 3 buckets. Government uncertainty, so things like the bill in the U.S., which we can get into more detail on in a moment. Policy uncertainty, which is what's happening with central banks. How do we forecast the reaction to this concern around stagflation, high probability of recession that has not gone away? And then, of course, there's the whole market aspect, which has to do with the fact that the dollar, which has traditionally been the reserve currency and has been the place where people think about a risk-free rate, is now competing against gold. We've seen the uptick in crypto, and obviously, as Peter said a moment ago, massive outflows into other markets.
Yeah, Dambisa, I mean, I guess what's very different from, you know, the other kind of crises is that this is man-made. So you could reverse some of the policies. You could, you know, be much more careful on the deficit. So are you expecting things to settle, or are we really in the unknown?
I believe we're in the unknown for the fundamental reason that these are structural changes that President Trump is trying to effect. And I've written actually quite extensively on sort of arguing for both sides of tariffs. I fundamentally am a globalist. I believe in globalization, but I think it's important for all of us to understand what the arguments are for sort of breaking up or really challenging the status quo, challenging the global markets. That's what President Trump is trying to do. I'm not here to defend that process, but I think it's very important for us to accept that we're not going back to the sort of low interest rate world that we were in. We now have real concerns around structural concerns around growth. We have concerns now about inflation, partly from tariffs, but also real concerns about what happens in a deglobalized world. Does that mean the cost of labor goes up? What happens in terms of commodities and other inputs?
Yeah, and massive concerns, of course, on the U.S. deficit. Right?
Absolutely.
We saw Elon Musk really speak up for the first time in the last 3 months against the president, against that bill. We've seen others, you know, Ken Griffin of Citadel 7 months ago speaking up and saying, like, we should worry about the deficit.
Absolutely, yes.
But what happens? Could it be just like a bond auction going badly in the U.S.?
Well, and it has, as we know, not too long ago. But also, it's not just the deficits, the debt. The debt is over 120% in the United States right now. Scott Bessant himself has spoken about concerns around not getting to some kind of a deal by August. And obviously, the Congressional Budget Office in the United States has forecasted that deficits will be at 6% still in 2035. So structurally, again, we're not solving the underlying problem. The deficits are getting bigger, even though there are some sort of a reprieve in the middle there, but it's still fundamentally still going to be 6%, which is, it's certainly nearly double the amount in the peace times over the last 50 years. So real structural change. I do worry about the deficit. I think it's being reflected partly in the bond yield moves that we've seen, obviously in Japan, in the UK as well. And I think it's those type of structural gyrations that investors have to focus on.
Stagflation, I mean, this is stuff of horrors for investors,
yes.
Central
and
bankers,
policymakers yes.
to get out of. Are the risks of stagflation rising?
Yes, absolutely. And, we've heard Jamie Dimon talk about that. The growth picture has been fundamentally problematic for some time, and we've seen, notwithstanding the revisions from the IMF over the last 48 hours for the UK, we saw that the IMF forecasts in April were for lower growth, under 3%, which, as I always say, is necessary in order to double per capita incomes in a generation. So structurally, we were already on a path of growth decline. Now we have an inflationary problem, partly because of risk of wage ticking up because of border controls, but partly because of the tariff prices that we've talked about already. But it's absolutely, we're in a world where inflation could tick up quite aggressively here, and that means obviously rate increases, which has implications for borrowers and savers, but also for investors.
But again, it's not really priced in at the moment.
Yeah.
Not a lot of concerns are priced in, and I don't know whether, for example, we worry about inflation, but it's not come through the data yet. So whether we're in a weird bubble at the moment where data will start to turn.
Yes, and so, I just wrote a piece not too long ago talking about what the data is telling us. Obviously, the soft numbers, I think, were flashing, certainly in consumer sentiment, even though the most recent numbers look much more constructive. The real concern was that what we're seeing in the sentiment market, but not really seen in hard data. I do think many people like myself who sit on corporate boards are looking at hard data and worried about a turn, and whether that comes from China, whether it comes from the hot wars that we're experiencing, that continue to experience around the world, it's not clear. But certainly, I think that there's flashing red now in the bond markets, and that's what we're focused on.
What are boards talking about? So you have a huge disruptor, which is AI, and underlying, I imagine that it's still quite difficult to say, I want to spend, $2 billion, $100 billion here or there, given all of the uncertainty.
So fundamentally, my whole philosophy, and my board colleagues, I think, would agree on this, is let's just focus on the things we can control. Right. There is more uncertainty, but we're still managing processes, we're still managing and thinking about investment, even in these challenging environments. We're thinking about different regions, we're thinking about different products, and of course, fundamental shifts like AI are a big piece of the discussions that we're having. But also, we have to manage the business thinking about, should we be thinking about borrowing more, borrowing less, given where bond yields are forecasted to go? How do we pass on or think about passing on the prices of higher inflation? How do we think about managing the staff and opportunities for employment globally in a very uncertain world?
You mentioned gold and also crypto moves. Gold is behaving as the safe haven par excellence. Does it continue that way? And what's crypto now? So
I feel a little bit tainted here. I was actually on the board of Barrick Gold, the largest gold producer in the world, when I was on the board. And so I feel like I'm always a gold bug. But even I had not forecasted it would get to over $3,000, which is where it is today. I'm much more of a gold person than I would say of crypto, for all the arguments that are known. But, even for me, seeing crypto at $108,000, certainly monitoring that as well.
Yeah, because crypto was meant to be again, I know it's policies, that there's a love inside the Trump administration for crypto.
Yes.
But it's unclear where it goes from here, right?
Yeah, absolutely. But it always has been unclear. I think there's no underlying discounted cash flow model to say, oh, this is where it should be priced. I think it's very much driven on sentiment. We're seeing that. And as I said, I joke with my husband that, several years ago we were debating, should we buy or not? It was at $3,000. And now it's at $108,000. And you think, I just can't imagine that it's gotten this high. So I think it's a wait and see thing.
Yeah, it's pretty crazy. I think Matt Miller, actually in the U.S., says he could be a billionaire, but he forgot the password. So that's another problem that some people have. Dunvisa, thank you so much for joining us today. Dunvisa Moyo, principal at Versaka Investments. Now, Stellantis has named Antonio Filosa as its new group chief executive to replace Carlo Tavares, who quit abruptly in December. Let's get more from Bloomberg Southern Europe managing editor Tommaso Ebhardt in Milano. Tommy, thank you. So who is Antonio Filosa? I know you've been following this very closely. Who is he and why was he picked as chief executive?
Ciao Francine, buongiorno. We talk in Italian because Antonio Filosa is Italian. He was born in Naples. He has been working for Stellantis since 1999. So we can say it's a little bit a comeback of the old guard which ran Fiat Chrysler under Chief Executive Officer Sergio Marchionne. It was Sergio Marchionne. He was Sergio Marchionne who essentially made Filosa one of the top managers. Filosa was seen in the past as what Marchionne used to call the young punks who are ready to succeed me. So somehow it's a comeback of the Marchionne people running Stellantis. Clearly, it's a very difficult job. Filosa, yes, he's Italian, but was now overseeing the North American business, the most important business of Fiat Chrysler. He has been working closely with John Elkann in the last 6 months, including visit to the President of the United States of America, and he's getting a big task.
So what are his priorities and challenges? I love that, the young punks. What's this young punk's priorities?
I mean, clearly, priority number one for Stellantis remains North America. Is the region where Stellantis used to make most of its profits. So priority number one is to fix the North American business. Then obviously to lead the transition in Europe, very complicated market where we have started years ago a journey to electric vehicles, which is now facing probably some delays, and then to grow in Asia, possibly look at China. So has a lot of things to do, clearly.
Tommy, thank you, as always, Tommaso Ebhardt there with the very latest on Stellantis. Now, coming up, Ukraine calls for $30 billion to boost weapons production as President Zelensky prepares to meet the German Chancellor in Berlin. We'll have plenty more on that next, and this is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Season is here.
European earnings season in full swing. They're coming left, right, and center.
It is the earnings season that is dictating the narrative.
Bloomberg is first to break the numbers.
The banking sector, that is the auto sector, HSBC, BBVA, BNP Paribas,
Continental, Ferrari.
All of them really delivering.
With the smartest insights.
I think the rebound that we have seen has been surprising.
The results hit another record high.
Continuing coverage on Bloomberg. Context changes everything.
Bloomberg actually has learned that Ukrainian President Vladimir Zelensky is set to arrive in Berlin. I'm all confused, all muddled up, to meet the German Chancellor Friedrich Merz in a few hours. Now, this comes after Donald Trump said Putin was, quote, playing with fire over his attacks on Ukraine. Well, I'm very pleased to be joined by Bloomberg's Oliver Crook, who's in Berlin, who will unpack all of this in a calm manner. So Trump's criticism of Russia is definitely growing, Ollie. Is this significant?
Yeah, so listen, I'll try to unpack it in a calm manner. I mean, I think it was significant to get that tweet, or I should say that truth from Donald Trump yesterday about Vladimir Putin. I'll quote it directly here, saying that what Vladimir Putin doesn't realize is that if it weren't for me, lots of really bad things would have already happened to Russia, and I mean really bad. He's playing with fire, and this in reference to the massive bombing campaign that the Russians have been conducting against the Ukrainians over the last few days. Some of the biggest days of bombing, really since the beginning of the war in more than 3 years, have occurred over the last few days. A number of civilians killed, and this has really upset the Trump administration and Donald Trump himself, who has been trying to bring the two sides together to a ceasefire and discussions and bringing them to the table. That, of course, does not seem to be Vladimir Putin's intention. This is what we've kept hearing repeatedly from a number of leaders of Europe, and potentially it seems that the Trump administration and Trump himself is beginning to feel that that might in fact be the case. What is now waiting in the wings is this bill that has been put forward by Lindsey Graham. It's ready to go. This would mean secondary sanctions on the Russians. This would impose sanctions effectively on third-party countries that buy oil and gas from the Russians. This would have a huge impact on restricting the flow of money to the Russian war machine. It's hard to say if we're really actually any closer to those going into force, but that is the threat that potentially is hanging over any sort of displeasure that Trump has over Putin and his conduct in this war.
So, Ollie, what can we expect from the Merz and Zelensky talks today?
Yeah, so what I think is interesting is this is really sort of the moment here for the new Chancellor, Friedrich Merz, to demonstrate what kind of ally he is going to be to the Ukrainians and to Zelensky. He's had a much more hawkish tone in terms of the tone he has taken versus Olaf Scholz. You know, he ran on a campaign saying that he would deliver these long-range Taurus missiles to the Ukrainians. These are very long-range missiles that the last Chancellor basically thought were too risky to give to the Ukrainians because theoretically you could strike as far as Moscow with some of these missiles. The problem is that he has not committed, Friedrich Merz, yet to actually sending these since he's taken over as Chancellor. So is that an announcement we could get a little bit later, as the two will be meeting in about an hour's time outside of the Chancellery here in Berlin? And we should remember also the important context here. We're waiting for the summer. There are a number of 50,000 troops amassing on the Russian border near Sumy. This could mean another summer offensive. We also get to a point this summer when that aid runs out from the Biden administration, that old set of aid, and that the Ukrainians are going to be looking for more military equipment. That is why they're now asking for $30 billion in order to boost up their own industries. That's the latest reporting in those comments that we had from Zelensky yesterday. So it's really a critical moment, and any sort of support that we're going to get for Ukraine is not going to come from the United States. It might come from Germany. This is the place that is now going to devote $60 billion to their military this year. They've removed the debt brake, and really Friedrich Merz, as a top priority, has said Germany is going to be a military industrial powerhouse.
So, Ollie, very quickly, I know you mentioned, well, we could find out today whether Germany will send Taurus missiles, but it does seem that, the relationship between countries and some of the missiles they send is very different from European country to European country.
Yeah, and it was made really complicated over the last few days from Friedrich Merz, who basically said that there was no limits on striking within Russia from Germany. Remember, Germany was one of the holdouts. The UK and the US have said it's okay to strike within Russia as long as you're taking on military targets. Then a few days later, he sort of walked it back a little bit and created a great deal of confusion. And there was criticism even within his own party saying that basically you need to take a clear line on this because it makes it look confused. It makes the European position look muddled. We need clarity, not confusion, because it makes the Europeans look weak to Vladimir Putin. So maybe we get some of that clarity a little bit later today.
Ollie, thank you so much. Oliver Crook there with the very latest, of course, on Merz and Zelensky. Now, super long Japanese yields jumped after an auction of 40-year sovereign bonds met the weakest demand since July, adding pressure on the government to reduce issuance. Well, let's take a closer look at that bond story with Bloomberg's Rachel Evans. So, Rachel, thank you so much for joining us. I mean, it's a massive, massive week in terms of bonds. What did we find out after yesterday's move in JGBs?
Yeah, well, I think we found out from the auction today that move was perhaps a little optimistic, that we would kind of be seeing the rally continue. We saw a poor auction of 40-year debt today, as you noted, and that's following on from the poor auction of 20-year debt last week. So that tells you that there's still this kind of mismatch between sort of supply of bonds in Japan and demand for those bonds. It's something that obviously, yesterday we were talking about kind of how the Japanese are looking to sort of try and reset, the kind of bond issuance mix to sort of address that, and they put out that questionnaire asking for feedback, and that's what prompted yesterday's rally. So I think that's kind of in the background, but clearly that sort of potential change in the future was not enough to convince people that they want to be in Japanese bonds today.
So, yesterday's global bond rally, just a brief pause, basically, in all of this repricing.
That's what it looks like, yeah. I mean, it certainly seems like the volatility is going to continue. I mean, when you look at kind of the events on the horizon, next year we have kind of sales of 10-year and 30-year Japanese debt. So another opportunity for investors to potentially sit on the sidelines. And as we head kind of further into June, we have a Bank of Japan meeting. Obviously, the Bank of Japan kind of tapering its bond purchases has been one of the causes of this kind of oversupply, if you will. So potentially what they say about kind of the pace of that tapering could also impact kind of appetite. And I think when you kind of overlay the fact that we also have US auctions, big ones kind of coming middle of June as well, 10-year, 30-year debt, testing kind of that broader global appetite for long-term bonds, things could stay pretty volatile.
Rachel, I mean, where do you look for in the last, next couple of days? There's, of course, ECB. It feels like a done deal. Are there any other, interesting points that you would look at? I was struck by the fact that Elon Musk was really against the big, beautiful bill that Trump was touting because of concerns around debt in the U.S.
Yeah, I mean, that's a really interesting narrative because that doesn't go away anytime soon. If you're thinking about what are the kind of sort of drags on US bonds and what will prevent, a rally from picking up steam, concerns over the fiscal picture for the US are definitely a very big part of that. And I think now we've seen kind of the US being kind of downgraded, sort of losing its kind of sort of last, of the top three for a AAA rating. I mean, that kind of is very much front of mind for investors. So it was interesting kind of, some of the commentary yesterday about this sort of questionnaire from Japan centered around whether the bond vigilantes had actually won in terms of getting the Japanese to think about this. And I think that's going to be a question now on the US side. Do the bond vigilantes up their game and start trying to push back against this bill and sort of agree with Musk that it's not actually that beautiful?
So in what kind of timeline? I mean, do we know, or could it flare up really at any moment?
I think it can flare up at any moment. The market's very fickle. It tends to kind of latch onto a narrative and that kind of gathers steam. At the moment, there's not kind of a huge sort of narrative around the US. It's been more focused on Japan. But as that kind of sort of changes, in the absence of any other news, you could see that kind of pick up. So I think, over the next kind of sort of couple of days, maybe, but certainly as we head into kind of like the middle of June with those US auctions, as I mentioned, that becomes another sort of focal point for people to kind of see whether there's a foreign buyer strike.
Rachel, is there anything else when it comes to UK gilts or anything else that we should be watching out for, maybe more locally?
I think, you mentioned the ECB on the European side. That's obviously going to be a big sort of thing for people to be watching next week. Widely predicted to kind of have a cut that's pretty much priced in. So I think that's pretty much baked into the market. On the UK side, there's a lot of kind of the political commentary around some of the domestic politics. Is this kind of two-child cap scrapped? Or is the winter fuel payment back? And that has a really big impact on the fiscal headroom that Rachel Reeves has and how bond investors then view kind of the UK's integrity and its fiscal responsibility. So I think that will be something to watch as well.
Rachel, thank you so much. Rachel Evans there with the very latest, of course, on the bond markets. Now, don't miss Bloomberg Technology's special coverage of those NVIDIA earnings. We'll get, of course, reaction to the numbers from the chief executive, Jensen Huang, as well as investors and analysts. That's at 11:30 p.m. UK time. Up next, Bloomberg Brief, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, and we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Fiscal doubts prevail. A soft auction in Japan brings more pain for global bond investors. And the main event, after adding $1 trillion in market cap from the market bottom, NVIDIA reports after the market closed today. And a leak, lost control, and disintegration. SpaceX's rocket fails a test for a third consecutive setback. So we are weaker this morning after we were able to snap 4 days of losses, one of the worst weeks last week since the April 2nd Liberation Day. It is softer today, but not by a huge amount, down about 0.2% across the futures for both S&P and NASDAQ. We will get NVIDIA after the bell. Will that help revive some of that risk appetite? So much hinges on this huge stock. One of the other things softening risk appetite this morning was a 40-year auction in Japan of bonds over there. That was the weakest since last July. This after the MOF reportedly had sent out a survey to different market participants that they changed their formula. Even so, it was not enough, and you can see the reaction, at least in duration. The front end's doing fine. We're lower by 2 basis points, but your 10-year and 30-year yields are up by at least 2.5 basis points. So those are your overall markets this morning. Let's look at some of the individual stocks, and with that is Bloomberg's Joe Easton. Good morning, Joe.
Hey, Danny, so it is a big day for the tech sector. It's that moment that we get out of bed for the NVIDIA quarterly earnings report coming up after the bell today. We're seeing the stock very slightly lower. Now, remember, NVIDIA already did a big write-down related to some of the sales that they cannot do to China because of the restrictions that were imposed by the White House. We'll wait to see if there's any update on that, but really a key moment for that sector after the bell. NVIDIA, though, down 0.3% today. Then the other earnings report, this one potentially coming before the bell, is Macy's. We're going to get the report out of them, and some analysts saying they may actually scrap their guidance due to weak sales
at the retail and potentially even an impact on tariffs in terms of the cost. Finally, one that's a little bit off the radar. This one is BROG, B-R-O-G. It is an energy company selling a lot of assets, but I do like that ticker, BROG. We're seeing that one up almost 50% this morning, probably going to be one of the biggest movers down in the small cap energy, Bruges gaining, and all of this available on the Before the Bell opening wrap as usual today. Danny.
Joe, appreciate it, and we'll catch up with you later in the hour. Also in this hour, in just moments, we're going to be talking with JP Morgan's Nandini Ramakrishnan. Later this hour, Stephanie Guild of Robinhood on the risk around equities. Also, don't miss our Bloomberg Technology Special. That'll be featuring an interview with NVIDIA CEO Jensen Huang. That's much later today, 6:30 p.m. Eastern Time. Now, in the meantime, as I mentioned, there was a poor auction in Japan today, and the pressure has resumed on duration, be it the U.S., be it the U.K. Already the U.K. and Japan have taken a leaf out of the U.S.'s book, potentially pulling back on long-term issuance, something that Janet Yellen had done here in the U.S. and resumed by the current administration. Joining us now is Nandini Ramakrishnan, EM Equities Macro Strategist at JP Morgan Asset Management. Nandini, thank you so much for joining us this morning. And this is an interesting one for you because this is something that typically happens in emerging markets. Brazil, Egypt, they can't issue long-term debt because the demand isn't there. Do you see a parallel to what's happening in developed markets right now?
Well, I think we need to understand why this is happening, right? As you mentioned, supply and demand dynamics are definitely one of the culprits for some of the Japanese market dynamics going on right now. But we also have to think about fiscal concerns, especially in the U.S. and Europe, where perhaps governments are spending a bit more than they can necessarily afford. Deficits are widening. This is absolutely an EM concept, something we're very familiar with. But in fact, we've seen quite a lot of fiscal discipline in EMs over the past several years, which is why actually we think this flip in DM markets makes EM slightly more attractive when you think about the countries that have been doing well. It's not necessarily Egypt or Brazil, but countries like India, parts of ASEAN, where issuance has been pretty tame and market demand for long-dated bonds has been actually okay. So I think this is an interesting moment where an EM typical problem has sort of come into DM markets and is really making the playing field quite even globally.
For sure. So does that mean, Nandini, that demand for bonds in general, if it gets sucked out of Japan, the UK, and the US, does that change allocation to emerging markets? Is there a case to be made if the risk-free attributes we usually assign to something like the US cease to exist or at least are diminished, that money gets spread elsewhere?
Yeah, this is a huge topic we're speaking to with our clients, with our investors internally. Let's make no mistake, I don't think EM government bonds are taking the place of U.S. risk-free rates in terms of asset allocation decisions from kind of capital stacking or risk allocation perspective. But I think definitely the diminishing of that U.S. exceptionalism or the idea that U.S. treasuries will perform no matter what, the Fed is there, the fiscal side of the U.S. is solid, those questions have made asset allocators think a lot more about if you want to add some risk and some diversification, you really are looking a lot more at emerging markets who have a lot of space given this macro environment, right? It's playing out the most beautifully in the weaker dollar. And this is great for emerging markets because there's space for EM central banks to cut. Their currencies are strong versus the dollar. There's also quite a lot of diversification within EM where as investors are looking for countries that don't necessarily have huge impact from the trade and tariff situation, there's countries like India, Brazil, parts of Southeast Asia, Middle East actually, that have very little of their equity market revenues come from trade or exports. And so when you can find these pockets within EM or just generally non-US equity markets, it's actually becoming quite interesting for investors to pivot a little bit away from the classic US S&P 500 trade to thinking about where you can find economies and equity indices that are more immune to global effects like trade and fiscal worries that are going on in the U.S. currently.
How are you viewing, to what extent other emerging markets are immune from global trade, Nandini? Because in Trump 1.0, companies had a huge restructuring in that they moved away from China. They moved into different, especially South Asian markets in order to avoid some of the tariffs. This time around, we're talking about at least a 10% baseline tariff on all of those nations, if not more, in places like Vietnam, where discussions there were really rapid in the beginning but have since gone quiet. What is the corporate appetite at this moment to move into some of those nations, or is it a standstill? Is it a freeze?
I think the uncertainty that the tariff negotiations and everything that has happened since the beginning of April have certainly made companies globally very concerned. You can see the mentions of uncertainty or tariffs in earnings calls globally has risen exponentially. So I think it's a very difficult environment for corporates to make decisions about reshoring. The good news is a lot of them from Trade War 1.0 have been diversifying their supply chain, a lot of that moving from China into Southeast Asia, into parts of India. But make no mistake, I don't think we're saying, Vietnam is going to win on the trade scorecard here. There's a huge amount of dependency on exporting to the U.S., not a lot of negotiation room for a country like Vietnam, but where there is space is countries that have low labor costs. So again, India and some parts of Southeast Asia score well on that. There's countries that don't currently have a lot of dependency on the U.S. who might be willing to increase their manufacturing capacity. So we have a lot of metrics by which we score possibility for corporates to move their production centers into other countries. But I think the unfortunate issue is that uncertainty regarding the actual tariff numbers does delay some of these decisions. But we do think that there is slow migration, slow diversification of those supply chains to make the global trade much more resilient. And companies that have already been doing that, we track several of those, have been more successful in terms of equity price or forward earnings guidance because of their forward thinking about this kind of reshoring and diversification of supply chain theme.
Well, one thing that was supposed to help, or at least allow temporary reprieve, was a delay to or a walk back of the 145% tariff on China, now just 30%. And indeed, the story around there, the narrative had shifted to one of, okay, all of a sudden we're going to get this pull forward. Surely shipping between the U.S. and China will take off. Torsten Slok of Apollo, though, has pointed out that there hasn't really been a rebound in trade between the U.S. and China. That's the chart we're looking at the moment, that if you look all the way on the end, shipments from China to U.S. have held on to that drop. I wonder what you make of that we haven't really seen this pull forward, this rush to get goods into America after that relief.
Yes, I think that chart and what's happening currently in terms of that uncertainty, in terms of export and import decisions, is a feature of quite what the shock was to the market from those early April tariff announcements. I don't think China is going to resume back up into its export dominance into the U.S., partly because even if it's 10%, let alone the much higher number of tariffs on many Chinese imports into the U.S., prices are still high. Sellers in the U.S., retailers, are going to be concerned about how they can pass through or not pass through that extra cost. So I think the situation for China from a macro perspective is definitely having to lean away from simple export dependency and thinking about how to find other ways, whether it's rerouting some of the goods through manufacturing them in other parts of Asia or the global south, as we just discussed, or perhaps finding more domestic demand for those products. And that's actually the big theme for us in China is, yes, the domestic macro situation has been very challenged in the past, the property market facing a lot of weakness last year, but we do think the worst is behind us. And if consumers in China can slowly get those green shoots of spending, some consumption back, that export that traditionally went to the U.S. could probably find some home in China. Now, that's a really rosy picture. I think we have a lot of stimulus announcements to come before we get to a really recovered consumer in China, but I think it's a wake-up call for Beijing to think about how do we get this stimulus to work, to actually absorb some of that excess export capacity that would have gone to the U.S. that now, unfortunately, as that chart shows, may not necessarily recover.
Nandini, such an interesting conversation. We really are going through some big changes right now. Thank you so much for joining us this morning. JP Morgan's Nandini Ramakrishnan. Let's get you some other stories now that are trending on the terminal this morning. And we had a third setback in a row for Elon Musk's SpaceX. A Starship rocket was destroyed during a test flight on Tuesday after suffering a leak, tumbling out of control in space, and disintegrating as it hurtled back towards Earth. Spaceship is critical to Musk's vision to transport people to Mars. And as we've been discussing, more pain for global bonds after a 40-year auction in Japan saw the weakest demand since July. That weak appetite puts additional pressure on the government to reduce issuance after a report of a survey that the MOF was looking at doing just that. Citadel Securities reported record profit in trading revenue in the first quarter of the year. Bloomberg sources say market volatility allowed the firm to post $3.4 billion in net trading revenue in the first 3 months. That's up 45% from the same period last year. Coming up, Musk's disappointment. The billionaire expresses frustration over the big, beautiful bill and how he says it will undermine the work of Doge. We'll discuss. That's coming up next on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not doesn't decrease it, and undermines the work that the Doge team is doing.
Some concerns of the deficit hawks among the Republicans who believe that the GOP's big, beautiful bill costs too much and demand more spending reductions. Joining us now is Bloomberg's Bill Ferries. Bill, one of the things I take away from this is the degree to which Musk's influence has started to wane. At one point, there was a concern that if you didn't fall underlined behind him, he would primary a lot of people. But it seems that these concerns that the deficit is ballooning, not really breaking through this bill, making its way through Washington, D.C.
Yeah, I think since Musk has kind of stepped away from those Doge efforts, he said he's going to focus a lot more on his companies, including Tesla and SpaceX, that his influence has waned. He's not at the White House quite as often. And I think, but I also think if you thought he was leaving politics totally behind, those are the kind of comments that shows he's still going to kind of poke his finger into things. But he's really echoing the complaints that a lot of the more conservative Republicans in the House and the Senate have. The Republicans in the Senate, including Ron Johnson, have almost said that this bill is dead on arrival, that they don't like the cuts to Medicaid, that they don't like the revenue projections they're seeing. You have other Republicans saying that the cuts to spending just don't go far enough. So I think there's little doubt that the president's big, beautiful bill, as he likes to call it, is going to undergo some substantial change, and that means it'll have to go back to the House, and there's going to be another dogfight to try to get something that both chambers agree to passed and sent to the president's desk.
Yeah, Ron Johnson saying yesterday, we are far away from an acceptable bill, and it's hard to say in terms of the timing. Elsewhere, Bill, there was some news around Fannie Mae and Freddie, the president posting on Truth Social, essentially saying that they would be privatizing the gains by taking Fannie and Freddie public, but socializing the losses with a not-so-implicit guarantee, which is what he called it. What does the future of these companies look like?
Well, this is something President Trump has been talking about since his first term. He really he had put then Treasury Secretary Steve Mnuchin on the job of trying to find a way to kind of end this conservatorship that's been in place now for almost 17 years. The shares continue to trade over the counter, of course, but as you said, the revenue generated goes to the government. The government has been paid back, I think it was $191 billion that it first poured into Fannie Mae. But I think this implicit guarantee was always there, the president making it explicit, but it's still not clear how that's going to work out and what it really means and how much the government is willing to foot the losses going forward if there is another big housing crisis.
I was going to say, it feels like the great financial crisis is so far from our memories that we look at something like this and don't even blink. Bill, we also had some news when it comes to Nippon Steel finally getting the approval to do the deal with U.S. Steel, but the U.S. is not ceding its control over this new entity. What is the so-called golden share that the U.S. will retain in this new company?
Yeah, I think there's still more questions than answers so far, but the U.S. indicating that there will be this golden share that effectively gives the U.S. government a veto over certain major decisions. Our understanding is that the board of the new company would have a U.S. CEO, a board dominated by Americans, but with obviously Nippon Steel officials or executives as part of that. It seems like the kind of agreement that would allow the U.S. to veto things like job cuts and production cuts that it doesn't want while green-lighting increases in hirings and things like that. It's really hard to understand how that fits in with Nippon Steel's original proposal. They put forward a $14 billion buyout plan. We know about the golden visa. We don't know really what some of these other details are and how this figures into the company's restructuring.
Bill, thank you so much for that update. We always appreciate it. That is Bloomberg's Bill Ferries, and you're watching Bloomberg Brief.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Take a look at the front pages this morning and what's making headlines around the world. First up, Shein is looking to IPO in Hong Kong instead of London. Sources telling Reuters that the fast fashion giant hasn't received approval from Chinese regulators to list in the UK. An initial attempt to list in the US was also derailed amid supply chain and labor practice scrutiny. Next up, the FT reporting an hour ago or thereabouts that the ECB President Christine Lagarde has been discussing leaving the central bank to chair the World Economic Forum. WEF founder Klaus Schwab told the FT that Lagarde had been at the center of a plan to replace him for years. Lagarde's tenure at the ECB is supposed to end in 2027. Finally, the Wall Street Journal leading on their front page with bets that the worst of Trump's trade war is now in the rearview mirror. The latest sign for investors was an easing tensions between the U.S. and EU last week, which preceded a 2% jump in the S&P on Tuesday. Now, meanwhile, Stellantis shares, those are slightly lower in the pre-market, but we did get news that the automaker has appointed its America's head, Antonio Filosa, as its CEO. Joining us now is Bloomberg's managing editor for Southern Europe, Tommaso Ebthart. Tommaso, we have a new CEO. What do we know about him?
Hi, good morning. We know that Antonio Filosa, Italian, born in Naples, has been working at Fiat for over 25 years. He started in Italy, then moved to Brazil. He was the head of the Brazil unit for several years. It was one of the most important units for Fiat Chrysler, and later he was appointed as head of North America. He's clearly a person coming from inside the organization. He was very close to the the former CEO Sergio Marchionne, who dubbed this younger manager under him as the young punks who were going to lead the organization at a certain point. But the moment has arrived for Antonio Filosa. His appointment clearly showed two things. One is that Stellantis is facing a very complex period. They need a person who comes from inside to run the organization. And second, the importance of North America is the main market for Stellantis, and Filosa, being an Italian, grew up in Brazil as a manager, now was leading North America, and this showed that North America and the US is really central for Stellantis.
That is an interesting point, because it is also sliding sales that they are grappling with, not just in Europe, but the US too. What is the turnaround effort that this new CEO is going to have to undertake? Just how mammoth is the task, Tommaso?
But clearly, he has to start from Detroit, from the Jeep brand, which used to be a cash cow for Fiat Chrysler and now for Stellantis. So he really has to fix the North American business, because this is where most of the profit can come from. And then he has to lead a transition in Europe to electric vehicles. It's going to be a long transition, a difficult transition for the old continent. And then he also has to look at Asia and at China, where innovation is coming from, and which is now the biggest world market for cars.
Tommaso, thank you so much for joining us this morning. Big changes at Stellantis. Tommaso Ebthart there. Now, coming up, we're going to catch up with Stephanie Guild of Robinhood on how stocks could continue to grind higher from here. They're taking a breather this morning with your futures down about 0.3%. This is Bloomberg.
to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Fiscal doubts prevail. A soft auction in Japan brings more pain for global bond investors. And the main event, after adding $1 trillion from the market bottom, NVIDIA reports after the market closed today. And a leak, lost control, and disintegration. SpaceX's rocket fails its test for a 3rd consecutive setback. Well, we were able to snap 4 days of losses yesterday, but today it is a weaker future session. Not by any huge amount, but we are down about 0.2% for your S&P and NASDAQ 100 futures. We'll get those NVIDIA results after the bell. Will that turn things around? But in the meantime, it was a weakness for a 40-year Japanese auction. That even though we had reports of authorities rather, suggesting that they might make moves to ease those concerns of pulling back on duration auctions and duration supply. Even so, that poor auction means that duration in the U.S. getting hit this morning, higher by about 2.5 basis points for your 10 and 30-year yields. But meanwhile, that front end stays well anchored thanks to the Fed. That's lower by 2 basis points at 3.95. Those are your overall markets. Let's get some stocks to watch. Here with that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So it is a big day for the tech sector. We will get NVIDIA numbers after the close of trading today. As you said there, the main event, the moment that we get out of bed for the stock market in terms of the tech space. We can see it ticking to unchanged at the moment. You don't want to be piling into that one ahead of that report, but we should see some volatility coming into NVIDIA when that results report hits later today. Then in terms of the other one coming out, we've also got Macy's, this in retail, potentially going to be pulling their forecast according to analysts. That's what I read on the previews in terms of that one. Potentially some impact from tariffs coming through into Macy's as well, so keep an eye on that one. That one should be out before the bell. And then finally, Bruges Energy down in the small caps. We don't look at this one too much, but I do like the ticker BROG. BROG got a nice ring to it. That one up 67% in the pre-market. They're offloading a load of assets based in the Middle East, so potentially that one is going to be a sharp rise. There are going to be some happy BROG investors later today. Keep an eye on that one at the open of trading. Danny.
Hey, Joe, really appreciate it. And yeah, what a way to invest. Just choose the tickers you like. I think that's a great strategy. Joe Easton there. Thanks for your work this morning. Now, elsewhere, U.S. stocks have posted a 19% rally just thereabouts from the April nadir. Barclays analyst Emmanuel Ko among those who say that the path of least resistance is stocks higher with positioning still low. He wrote that absent a volatility shock, systematic buying could continue to help equities to grind higher. Let's add another expert voice to the conversation. Joining us now is Steph Stephanie Guild, CIO of Robinhood. Stephanie, it's a market that people are hesitant to be too bearish on. Would you agree with that the path of least resistance is higher from here?
Yeah, I think the whipsaw factor is high, is like I like to say, because if you get too bearish and you really focus too much on the negatives and the risks in the marketplace, you can end up being, caught flat-footed. I think of it as like when you're driving and you have to really focus, you turn down the radio. The sound has nothing to do with it, but you kind of have to focus, like turn down the sound and say like, okay, what are the opportunities? What are the risks? And despite the fact that the overall market doesn't look as attractive as it might have at its lows this year, there are still opportunities. We're seeing mid caps is actually cheap. They're at 14.5 times. The long-term 10-year, excluding 2020, was 19 times. And the other thing I would say is that at the stock level, there really are many opportunities. And so that's where I think you kind of have to like focus. And at the equity, kind of broader equity level, sort of neutral to holding a little bit of dry powder.
By the way, I love that metaphor because we all do it. It makes no sense. You turn down our loud music and it helps us see.
You cut one of the senses out and heighten the other one.
Exactly, Stephanie. So as you're sorting through and seeing what makes sense, I was looking that you're kind of envisioning two different scenarios. One in which low tariffs doesn't really affect the economy and you can buy cyclical growth. The one in which it does and you lean towards non-cyclical growth. Those are two bipolar outcomes.
I had a third one, but actually just tried to be more focused. Well, I was like being more like kind of dividend stocks and cash, dry powder, and then kind of low volatility stocks.
Well, one is definitely more risk friendly, one's more risk adverse. But when we know the outcome of what tariffs will actually look like and what it does to the economy, it feels like it's so far away. So what do you do in the meantime before you can really get that gauge?
So it's not that. July 9th is like the next, right? And I think there's another one in August for the China tariffs. So it's actually not that far away. I think, if you look back historically at the market too, it's not sell in May and go away, but it's sell in July and go away. So I'm sort of thinking that there's continued opportunities. We still have earnings coming out. And you do have a little bit of a balance with a bias in that non-cyclical growth theme, because I do think growth continues to be in question, and also interest rates are the thing that I'm most worried about, actually, because you also have the budget debates, which need to be solved by July sometime, otherwise the government needs to shut down. And that looks scary. I mean, there's some senators in the Senate that actually do want to cut the growing deficit, but the one that passed in the House is not. We did have that auction that tailed. Not that different from Japan. Japan, however, has a greater debt to GDP. So I think you want to be diversified. And I think you want to make sure you have some foreign stocks in your portfolio. If you're a U.S. investor, I think you want to make sure you have a little bit of dry powder to take care of the times when we do have those tariff scares. And I think you want to focus on areas that are going to grow kind of through this, right? Like, turn down the volume and focus on what can grow through this, and for those long-term positions.
It's interesting. We were talking with JP Morgan's Nandini Ramachandran earlier, who's an EM strategist, and was saying what's happening with long-duration yields in the dollar looks a lot like EM. It's a sentiment that's been echoed elsewhere, where there's less demand. Well, so what does that mean for the equity market then? Is there not some risk that investors just pull away from U.S. assets in general? Because they're certainly at least nervous when it comes to rates in the currency.
I mean, I think you've already started to see that. Like, that's why you've seen international stocks do better than the U.S. this year. I think you also, if the dollar isn't going to be as strong as it was before because its kind of power dominance is in question, then that's an even more reason to make sure you have diversity in your portfolio globally. And I think up until even this year, that wasn't something that really mattered that much. Like, you could just completely be in the U.S.
Do you do that within the U.S., i.e. you choose the global companies who have that international exposure and also might get a help from a weaker dollar?
That's not necessarily the way we've been playing it, although we do have some international, global companies in our portfolios, but our Robinhood Strategies portfolios, by the way, but we have been allocating to specific things like Japan, actually, but currency has Japan because we're not sure what's going to happen with rates relative to the U.S. We've been investing in Chinese tech companies because we actually think that they're really undervalued, and they do have that kind of through the growth, right? And AI is a big theme in China. And then we do have some large cap European stocks. So we've kind of been going across.
Speaking of tech, if I can just jump in, we are going to get NVIDIA later today. How much will that color not just your allocation to NVIDIA itself, but some of these AI names?
I mean, expectations for this quarter are not that high. If you look, like, I think it's 19% growth, and this time last year was like 400% growth. So I was worried last quarter more because I was afraid that expectations had gotten too high. And I think that is everything when it comes to this name. We actually have seen our own our own customers. It was something they were jumping into a lot when the stock price was down, but in true fashion of what they do, when the stock price appreciates, they tend to trim. So they've been taking some money off the table. We have a small allocation in our portfolios, but we're certainly not overweight. We're kind of applying, like, maybe feels like I'm kind of like playing too much on both sides, but a 60% chance that they beat. I do think it's interesting that Jensen Huang's going on TV after earnings.
6:30 p.m. Bloomberg TV. Just let me get that plug in. Yes, continue, Stephanie.
Because why would he want to be kind of all over if there was something bad to say? But if expectations have already, like, if they're expected to, if they don't at least beat expectations, and it's, and they just meet them, like we're seeing that across the board. If you meet them, it's not good enough.
Or to play devil's advocate, maybe he wants to massage the message if things aren't great.
That's actually, I mean, that could be true. That's why we're not taking a big bet.
Honestly, the theme of the year, be prepared for very vastly different outcomes. Stephanie, I'm afraid we're going to have to leave it there. We could do this all day. Thank you so much for joining. That is Stephanie Guild of Robinhood. Let's get you now some other top stories that are trending on the terminal this morning. As we've been talking about, more pain for global bonds after a 40-year auction in Japan saw the weakest demand since July. That weak demand, despite reports that Japan was surveying market participants on adjusting issuance. Citadel Securities, meanwhile, reported record profit and trading revenue in the first quarter of the year. Bloomberg sources say that the market-making giant managed to ride market volatility, posting $3.4 billion in net trading revenue in the first 3 months. That's up 45% from the same period last year. Wealthy customers of UBS are looking to buy more alternative assets as they look to diversify during a period of heightened volatility for global markets. Sounds familiar. The firm's Asia-Pacific chief Iqbal Khan spoke to Bloomberg in Hong Kong.
We've definitely seen a significant growth of alternatives and alternative investments in clients' portfolios. It is still at a lower percentage when you think about an aggregated perspective of wealth portfolios. So there's probably still some way to go in terms of diversification into alts.
Coming up, a SpaceX setback. The Starship rocket loses control in another test failure for the company. More on that story coming up next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running it like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
See there, the red fire, another setback for SpaceX. More like smoke, I guess. There's some fire for you. Its Starship rocket lost control in space and disintegrated during a test flight. The stakes were particularly high after flights in January and March were cut short just minutes after takeoff when the Starcraft exploded. Joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, do we know what went wrong?
Not precisely, and I think, we're waiting for that data readout to come back from the SpaceX team. But, we've kind of come, I guess, a bit used to the routine of SpaceX sending rockets up. But this is like a huge endeavor, incredibly enormous rocket, very complex. I think obviously they would have wanted it to go better. I think Elon Musk was talking about an 80% probability that it would be okay. But that still leaves 20% of tail risk, so some setbacks there for them to figure out. But it will definitely not dim their ambition to kind of get this ship up and running, and potentially an unmanned voyage to Mars in the next year or two.
Well, we continue to have these timelines from SpaceX, from Elon Musk, that get challenged. How much of a challenge is this to that timeline, Matt? How big of a setback exactly is it?
Not insignificant. I mean, it could be probably measured in months, I think, in terms of the progress against, what's a kind of long slate of test flights. But, certainly when you think about manned trips to Mars, you need to have had at least a few successful unmanned trips to understand what's really kind of going on and what happens when you do these kind of deep voyages. So, I think there's still optimism about the time frame for any kind of mission to Mars, whether it's manned or unmanned, and it'll, I think, almost inevitably continue to get pushed out. We've seen that with the NASA mission already anyway. But I think we're not far away from Elon Musk sending some kind of mission to Mars. It's measured in low numbers of years, I think.
And maybe some renewed hope that Musk is concentrating on his companies instead of the government now. Maybe that will help. Matt, thank you so much. Matt Bloxham of Bloomberg Intelligence. Just want to bring you some lines from our autos team over at Bloomberg that Volvo Cars, the facility in the U.S., is currently paused due to supply chain issues. Just another automaker really feeling the pain. We don't have the specific of what the issue is in terms of that supply chain, but they have felt trade tensions really acutely. Journal, Reuters, others reporting yesterday that they're slashing about 3,000 jobs, Volvo Cars, mostly white collar, in reaction to both the EV demand slowdown and global trade turmoil. So that's one stock to keep your eye on there. Now, NVIDIA, another one. It is little change to the pre-market, a little bit weaker, actually stronger now, I should say, up about 0.1%. It is leading Mag 7 stocks. It did yesterday on Tuesday, and it has from the April bottom. The chipmaker is the world's second largest company by market cap. It remains front and center for investors who are trying to gauge what exactly is going on with AI. Joining us now is Bloomberg Intelligence senior tech analyst Mandeep Singh. Mandeep, great to see you this morning. What are you expecting from NVIDIA?
Yeah, I mean, we know the consensus expectations are $44 billion in revenue this quarter. And look, they have traditionally beat and raised, so the expectation is there will be at least $4 billion in sequential increase, so somewhere around 47 to 48 billion for next quarter. The caveat there is they took a write down on the Chinese revenue, and that was almost $50 billion. So if you factor that in, we're talking about overall 7% of their overall revenue being written down. So I'm just curious how they end up guiding for the next quarter, because it's not that obvious where that beat and raise will come from, even though they've signed a couple of deals in the Middle East, and everything else has been positive in terms of ChatGPT users going up. So overall demand side looks great, apart from the Chinese write down, which I think will weigh in on the expectations for next quarter.
Mandeep, just how different of a year is this for NVIDIA? It used to be, unless they delivered something that was an 100, 200% revenue increase, we would all be disappointed. It feels different this time, that the expectations are much lower. Just how low are expectations, given what you're saying, given the write-down that they've already announced for China?
I mean, I wouldn't call it, expectations have tapered, because they're a much bigger company now. They'll end up doing $200 billion in overall revenue for the year. So clearly it's harder to grow at triple digits when you are, that size business. And look, they're still the fastest growing among the Mag 7 companies. So a company that's delivering over 50% growth, that's phenomenal for a company of NVIDIA's size. I do agree with your assessment that, they are still a single kind of trick business when it comes to selling chips. They don't have a ton of diversification like the other Mag 7, but clearly there is a long runway given this is an AI super cycle and everyone believes in that. It's just that there will be an air pocket at some point, and everyone is trying to figure out when that air pocket and that digestion will be in the AI infrastructure super cycle.
What could cause that air pocket, Mandeep? Because to your point, all the hyperscaler earnings we saw, be it Meta, be it Alphabet, are still spending huge amounts on CapEx when it comes to AI and data centers.
Yeah, so you're right. I mean, next year may turn out to be another good year in terms of CapEx, and that's the wild card, right? So if all the hyperscalers continue with their spend next year, I think NVIDIA numbers may actually be revised upward despite the Chinese headwind. And they are coming up with a variant for the Chinese shipping to China as well. So there are a lot of unknowns, but you're right. I think that is the most important factor when it comes to sustaining this momentum in terms of CapEx from hyperscalers.
Mandeep, thank you so much for joining us early this morning. Looking to catching up with you after those results as well. Mandeep Singh of Bloomberg Intelligence. And don't miss our Bloomberg Technology special. We'll have an interview with NVIDIA CEO Jensen Huang. You're going to want to stay with us for that. That will air around 6:30 p.m. New York time. Now, along with tech and NVIDIA earnings, before the market open, we'll be getting some retail earnings. Macy's among them. Those shares are higher in the pre-market ahead of their first quarter results. For more, let's bring in Bloomberg's Andrea Felstead. Andrea, I guess you could say the retailer earnings have been uneven, let's call it. What is the expectation for Macy's?
Well, it's very interesting with Macy's. One thing that I'll be particularly looking out for is whether they are getting any benefit from some of the other turmoil in the department store space. We obviously had a new CEO at Kohl's, or the CEO left Kohl's abruptly. Saks is having issues. So it'll be really interesting to see whether Macy's turnaround is gathering speed and it's picking up some customers from these other stores.
Well, even the results that have been good, Walmart, Home Depot, again, posting strong results, but you continue to see this through line of value-seeking customers, that they aren't doing large ticket spends. For someone like a Macy's, when they are in the midst of this turnaround, how much do these companies need to focus on value strategies given the overall environment?
Absolutely. Value is key. In this type of environment, even if you have the money to spend, you're going to think twice about, spending it. And you've got someone like Walmart, the home of low prices, but even they've got competition with Aldi, the European discounter that's, expanding across the US. So value's got to be on everybody's mind.
Andrew, what just is your read? I mean, we'll have Macy's in the pocket after today, but what has been your read on this earnings season and where retailers stand?
It's obviously all tariff dominated. What's going to happen with tariffs is the key thing. Whether those very high tariffs, Vietnam, those very high tariffs on China are paused or they come back, that is a key thing. And what has that done to consumer confidence? There did seem to be sort of an immediate pullback from spending around the time, of Liberation Day. That feels like it's perhaps loosened a little bit. But, you know, what happens with tariffs? What happens with the consumer? What's going to happen with the supply chain? You know, we have this window to bring in goods. Is it going to be a tsunami or is it going to be a trickle? All those things are still very up in the air.
And again, it's remarkable to see that China and U.S. trade really has not ticked up, those shipments remaining low despite that pause. Andrea, always wonderful to speak with you. Andrea Felstead of Bloomberg Opinion. Coming up, earnings galore. We're going to set you up on what's ahead, including Macy's, including NVIDIA. All that to come in your trading diary on your Bloomberg Brief.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, let's set you up for your trading day on this Wednesday on a holiday-shortened week. We're going to get some retail earnings. Macy's, Dick's Sporting Goods, Abercrombie & Fitch, they all report before the bell. Then we'll get the latest Fed minutes, 2 p.m. Eastern, and then it's the main event, NVIDIA earnings before the close. We'll also have an interview with Jensen Huang, the CEO, at 6:30 p.m. Now, some individual stocks on the move. Now, AMC is weaker today, but it should be noted that they closed 24% higher on Tuesday, a record weekend admissions revenue for Memorial Day. We have it on good authority, aka our producer Maureen, that Mission Impossible was indeed a good movie, so go out and see it. Okta, that is extending post-earnings declines. It gave a weaker than expected outlook. Finally, NVIDIA, again, you just want to keep your eye on this. It will be reporting after the market closed. So much hope being pinned on the stock after it led us up from the April nadir. Now, just as we go to break, I want to take you out on a view of what yields are doing because duration is getting hurt again after a weak 40-year auction in Japan. Are things changing? Are we starting that buyer strike for long-term debt? All right, that's it for your brief. Surveillance will take things from here.
Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is a risk premium for U.S. assets that was not there before.
Investors should be overweighting or certainly exposed to non-U.S. markets.
We're having our usual bulls versus bears debate.
This notion of U.S. exceptionalism being over is a narrative. I don't buy it.
There's nothing that beats our capital markets. They continue to be the envy of a world.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, Elon Musk is pushing back.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Doge team is doing.
The tech titan disappointed by the tax bill making its way through Congress. As a weak 40-year debt sale in Japan keeps the pressure on the bond market, equity investors turning their attention to NVIDIA, wrapping up Mag 7 earnings after the closing bell.
If you wanted any example of how this year is really just an exercise in wildly turning to nowhere, it is NVIDIA, which is up 44% from the lows in April, but up just 1% year to date. And what we have seen is a company where there is a real question of how much the narrative has shifted. Yes, China can't provide that incremental supply, that incremental demand, but at the same time, can they replace that maybe with the Middle East, with other customers?
Demand hasn't been a problem at NVIDIA for years. It's always been about supply, whether they can meet that demand and whether they can get around the restrictions down in Washington, D.C.
It's about supply, and it's about the walls going up. And we saw that in April with the Trump administration basically saying these chips that NVIDIA made to make sure they can go to that critical market of China and export there from the Biden era, the Trump administration says, no, that's not enough. We actually don't want you sending any of this to China. And to Lisa's point, Jensen Huang was giddy in the Middle East when I was traveling with the president. He was at every single stop. And the question is there enough insatiable demand in the Middle East to fill the lack they have of that demand right now because of the walls going up in China?
We'll be catching up with Jensen Huang 6:30 p.m. Eastern Time. A little bit later on this evening, Ed Ludlow sitting down with the man himself after we get those earnings, so look out for that. Also focused on the bond market this morning. Yields are higher at the long end of the curve. Hello, Japan. Hello, a 40-year debt sale that didn't go too well.
Yeah, they had the weakest demand ratio since July 2024. Why? This is really the ultimate question, given the fact that the Bank of Japan owns most of the bond market. And you talked about yesterday how the Ministry of Finance came out and said, look, we're going to issue fewer long-term bonds. So then what was the problem? And that actually is giving more jitters to people who are saying, really, is this actually a risk-free asset, even if you have the backstop of fiscal authorities potentially reducing long-term issuance?
This is the supply out of Japan. Later on today, the supply out of the US in focus. Will get $70 billion of 5-year notes today. Tomorrow, $44 billion of 7-year notes. A heavy supply slate coming from Washington, D.C.
At a time when there's a real question about exactly what Elon Musk had to say, how much does the current budget plan increase the deficit, and how much are really talking about deficit concerns versus an economy that's still facing off with the potential for inflation? To me, this is, I think, the crux of the issue. What is driving the bond market? How much is actually fiscal? How much is actually inflation? And how much is it that people are just looking to alternatives because the volatility has been a little stomach-churning and they kind of don't want to deal with it?
Elon Musk says the bill can be big or it can be beautiful, but he says you really don't know. Can it be both? It's his opinion. The problem is, of course, is that what this administration is doing is when Trump came in January, this term came from the fact that a number of individuals wanted spending on immigration. Others wanted the tax cut. And Trump said, put it all together. And that is why you have a massive bill that I guess Elon Musk is now starting to read the CBO and the Penn-Wharton model. It's going to add trillions of dollars to the deficit.
He's pushing back. How many fiscal hawks in the Senate agree with him? Bond yields are a little bit higher this morning. Equity futures are a little bit lower. Coming up this hour, we'll catch up with Christian Nolting of Deutsche Bank as the rally loses steam, Ed Mills of Raymond James on the Nippon Steel tie-up, and Frank Lee of HSBC looking ahead to earnings from NVIDIA. We begin this hour with Stock Steady ahead of more economic data and NVIDIA results. Joining us now, Christian Nolting, the Global Chief Investment Officer of Deutsche Bank Private Bank. Christian, welcome to the program, sir. There has been a near obsession for a number of months now about the spread between the hard data and the soft data. The soft data has been terrible. The hard data has been resilient. A lot of people believe the hard data would catch down to the soft data. After consumer confidence yesterday, could you get your head around the idea that maybe the soft data could maybe bounce back up to where the hard data is?
Yeah, that's a very important question we're also discussing, right? Are markets too optimistic for what's going on? Actually, first, for the hard data, we do see growth coming down a little bit. So forecast for the US for this year would be 1.2, but then moving higher a little bit into next year. So that's hard data. I think that's not a recession. That's good news in a way. The soft data, of course, I would say let's not be too optimistic here. There could be some downside there, I would say. From that perspective, I think it's probably a bumpy road ahead, but if you look for 12 months, we do still see another 5-6% on gains, for example, on the S&P 500, but it will come with some volatility.
Yeah, it's been stomach churning, Christian. I feel like what we're going to get from NVIDIA just highlights just how stomach churning it is, given the fact that after their earnings reports, they tend to move about by some $200 billion of market value. I'm just wondering if we have any conclusion after almost 6 months of this year, this sense of where we are, what has changed in terms of both risk appetite and where the haven trades are.
Yeah, I would say what has changed a little bit is the volatility, clearly, right? We had long periods last years, I would say, where volatility was extremely low. But I think this year, and let's say also especially for the next 6 months, we will see more of that volatility. I think that's a change that's also factored to some uncertainty. What will be eventually the results of the trade tariff negotiations, very important from my point of view. But then the good news in a way was on the earnings so far. So earnings expectations have come down, but the earnings season we will see tonight, of course. But so far was a very decent one. From that perspective, that helped markets. Now in the second half of the year, we do think inflation will probably go higher even in the US. So that's number one, which could cause volatility. Then, of course, earnings have still to be delivered, but expectations are a bit lower. That could be a positive. And especially we think that for tech, digital earnings, for financials, that could be very positive. So that's good news from that perspective. But on the other hand, and as you rightly said before, we also need to look at inflation being higher, and that has that has a clear consequence on the yield side as well. So if we see yields then going substantially higher from where we are right now, I think that could also weigh on equity markets.
Christian, what's driving the bond market right now? Is it the expectation for inflation? Is it fiscal overhang? Is it just jitters over recent volatility?
Honestly, I think it's all three of that. So first of all, it's supply demand. We have seen this with Japan. We've seen that also in the US. We are having some discussions here in Europe as well. So supply demand on that side, especially on the longer end. Then secondly, I think there is in this market a lot of discussion about fiscal. Look, US, is Europe then able to spend fiscally in the right way to create productivity? Certainly, we do expect another, let's say, fiscal stimulus program coming out of China. So I think the second half of the year will be a lot of discussion on fiscal. And of course, it's overdone in a way that drives yields CP higher. So that's the second aspect. And as I said, if we see inflation going higher in the US, from my point of view, that would also drive yield more in the longer end, of course.
Christian, how are you navigating this positive correlation between stocks and bonds? The fact that the two asset classes are moving in lockstep, equities up, yields down. This morning, equities down, yields up. What are you doing with that?
So it's not so bad for a multi-asset portfolio of some diversification there. So that's something actually you like. And there were periods in past years where that was not the case. So from that perspective, diversification is key. That's not new. But I think as long as this big one works, I think that's a positive thing. However, it could well be, right, if we see yields to go substantially higher, i.e. losses on the price side, then you could see both assets in the equity space and in the bond space to go down. So that's why you don't have this negative correlation anymore. So from that perspective, what we do is we try to have a global diversified portfolio, and also in the bond space, not only look at government bonds, look at also investment grade, where we think there is a lot of opportunities, by the way, especially in Europe, also from the currency perspective.
Christian, you mentioned tariff negotiations, and a lot of this is driving what we're seeing in financial markets. You said you're keenly focused on them. So which ones are you most focused on?
Look, being based in Frankfurt, of course, there's a lot of focus on the European negotiations, and I think last Friday we got let's call it kind of a wake-up call with the 50% threatening. So that's, of course, now postponed to July 9th. But so it's Europe. And the second one is, let's not forget about this, is China. So that's the two main focuses we have at this point in time.
Do you think trade tensions, the peak uncertainty of all of it, has disappeared?
I think the ultimate peak, yes. I think we got this after April 2nd. Still then, I think it has come down a bit, especially then on April 9th, when Trump said there's a 90-day period. And if I'm not wrong, for China, they've also said if the negotiations go well, we can imagine this could be prolonged another whatever days. So I think we have seen the peak, but that doesn't mean we are very low now. It's still very high, the uncertainty, but I think the peak we have seen in the week from April 2nd to April 9th.
Hey, Christian, appreciate your time. As always, Christian Notting there of Deutsche Bank Private Bank. Sharp rebound in US consumer confidence in yesterday's session. Biggest monthly gain in some 4 years. And about half the responses in that survey came after the May 12th US-China trade truce. So that tells you a lot about how much more this could still be in the pipeline.
There was this feeling that people felt very concerned about both the inflation and the forward drag on growth in the wake of what happened on April 2nd. The ability for people to completely shift back their opinions, not only about the current conditions, but future conditions in a way that we haven't seen since the direct aftermath of the Great Recession in 2008 and 2009, gives you a sense of just how much can change in the soft data, not just the hard data.
Fantastic snapback in consumer confidence, and we hope to see more of that in the months to come. Equity futures on the S&P, negative by just 0.1%. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. As you showed at the top of the show, Elon Musk is pushing back on President Trump's tax bill. The billionaire who said he was stepping back from Doge last month says the bill undercuts what Doge was all about, slashing government spending. Speaking to CBS News, Musk said, "I think a bill can be big or it can be beautiful, but I don't know if it can be both." Meanwhile, his company, SpaceX, suffered a third straight setback for its Starship program last night. During a test flight, the massive rocket booster exploded before the Starship itself suffered a leak. It then tumbled out of control and disintegrated as it came back to Earth. It also failed to deploy dummy satellites as planned. And Stellantis has appointed a new CEO. It's America's head, Antonio Filosa, will now take the reins of the company. The automaker is hoping an experienced insider will turn around the automaker after former boss Carlos Tavares was forced out over weak sales and profit. That's your Bloomberg Brief. John?
Yahara, thank you. They've got a lot of brands to figure out what to do with, that's for sure. Yahara's going to join us a little bit later, again this hour. Up next on the program, making a deal with Nippon Steel.
I will stop Japan from buying United States Steel. I would not let U.S. Steel be sold to Japanese.
It'll be controlled by the United States. Otherwise, I wouldn't make the deal.
It's a big change for the President of the United States. We'll get into the why in just a moment. Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Live from New York City, welcome to the program. Equity futures just a touch softer here, negative by only 0.1%, basically unchanged on the Nasdaq 100. Under surveillance this morning, making a deal with Nippon Steel.
I will stop Japan from buying United States Steel. They shouldn't be allowed to buy it. U.S. Steel is being sold to Japan. I don't like that. I would stop it if it hasn't been completed by the time I'm president.
It'll be controlled by the United States. Otherwise, I wouldn't make the deal. I'm doing it because everybody seems to want it.
It's the latest this morning. President Trump surprising markets supporting the sale of U.S. steel to Japan's Nippon Steel. Sources telling us here at Bloomberg the U.S. government is poised to receive a so-called golden share as part of the tie-up. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, this is a big U-turn from a campaign promise. What's behind it?
Yeah, hey, John. So there's a few different things that could be here at play. We know that President Trump made this announcement after a phone call with Japan's prime minister last week. And also, this White House really has been seeking new investment commitments, and it appears that Nippon was able to sweeten the deal by offering up to $14 billion in new investment, up significantly from their originally proposed offer. Now, there are still a lot of big details here that are still missing on exactly how this is going to play out. As you heard, President Trump had vowed that U.S. Steel would never be foreign-owned, and instead it is now being billed as some sort of partnership. But really at the heart of the questions is that any sort of deal is going to have to abide by some sort of national security agreement in order to reflect conditional approvals by the Committee on Foreign Investment in the U.S., or CFIUS. And you mentioned one of them there. People familiar telling Bloomberg News that the U.S. is poised to receive a so-called golden share as one such condition. This would essentially allow the U.S. government veto rights on certain company decisions, things like offshoring or shifting supply chains. But John, at this moment, it's unclear the full scope of that and whether or not that would amount to some sort of equity shake or really equity stake or really simply just mitigation powers.
Well, Tyler, in January, the Biden administration blocked the sale. So procedurally, Trump needs to actually unblock it. And then he said on Friday he's going to Pittsburgh. So how is he going to sell this to Pennsylvania?
Right. I mean, this really was a flashpoint on the 2024 campaign trail. The Steelworkers Union was really against Nippon's bid, instead in favor of Cleveland Cliffs, instead making some sort of acquisition here. And actually, you'll recall the one place of overlap between the two candidates the day before Election Day was that they both went to Pittsburgh and ultimately vowed to block this deal. We have heard President Trump start to bring in his ideas of how tariffs have helped the steel industry. He said it in his post announcing this so-called partnership. And we should say, by and large, the steel industry has actually been happy with the more protectionist policies when it does come to steel. But it is going to have to be sort of threading the needle here for this White House, since we know that the Steel Workers Union really was against this on the basis of national security concerns and concerns about what this will mean for jobs. Anne-Marie, we had Stephen Myron of the White House on Bloomberg Television yesterday, and he said that the White House is confident that Nippon will make good on its investment and job security commitments.
Tyler Kendall with the latest in Washington. Tyler, thank you. To extend the conversation, Ed Mills of Raymond James joins us now. Ed, welcome back to the program. Let's just start with this deal. What do you think is behind the change of mind for the President of the United States?
They say the only constant in life is change, and man alive, does that apply to Donald Trump? So I think the reason why he was opposed to this deal in the beginning was that it was a political headache for Joe Biden. It was a political headache for the Democrats who are running for re-election in the Senate in Ohio, in Pennsylvania. Both of those Democrats lost. Now we are talking about a golden share. Where have we heard a golden share before? That was what we found out was going to hold up any sale of TikTok whatsoever. So Donald Trump criticized that structure and now is embracing that structure. This is a political move because, as mentioned, there are a lot of folks within Pennsylvania who are employed by U.S. Steel who want a deal to get done. There was a kind of infusion here by Nippon that a lot of folks look at as very positive. And so now that a lot of the locals who could have suffered some job losses have been on board, it gives Donald Trump the political cover to get this done. And at the end of the day, what does Donald Trump always want? He wants investment in the United States. And if he can get investment and he can tie that to the trade deal, he's going to move forward.
What is basically in this golden share? What does the U.S. get?
Nobody knows. And so we have to wait to find that out. And when I talked to investors about this deal yesterday, one of the big questions is, what will be the final price of this deal? And once you do issue a golden share, do you need a new proxy? Do you need a new shareholder vote? This elongates the timeline. We've gotten information via tweet, but the actual information here has not really been fully fleshed out. And so once we know what that is, we can answer some of those other questions. But it is a big question for the merger arb community in terms of, is this new policy? What exactly does this mean? What is the timing behind this? We maybe, if we have an equity stake, does this go into the sovereign wealth conversation, the fund that he's trying to create? Is this part of a larger conversation about the debt and the deficit? Nobody knows yet. A lot of details, Anne-Marie, to be filled in.
Well, golden share sounds like a great branding opportunity for the Trump administration. Based off what I've read and some of the reporting out there, basically what they want to do is make sure that they have U.S. government approval of the number of board members, U.S. members on the board. Also, in a CFIUS-like agreement basically could mean that they have rights over actions like offshoring and shutting down production lines. If that is the case, Ed, is that politically enough for Trump to go ahead with this deal?
I think so. I mean, those are all going to be things that you could have put in a mitigation agreement. When I was on Capitol Hill, I worked a lot on the creation through legislation of the CFIUS process. And when we looked at this deal last year, there was no one with a straight face that said you couldn't use that process to come up with a mitigation agreement. But politically, if you say, hey, we will not allow U.S. Steel and kind of owned by Nippon to cut production, we say it's okay. We will not let U.S. Steel export any steel unless we say it's okay. Politically, that deals with the national security issues that the Trump administration has been trying to deal with the different Section 232 tariffs. So anything that allows him to not have to explain away some of the national security concerns he's already brought up is political cover that can get this across the finish line.
Well, the deal was blocked in January by then President Biden because of national security concerns. How does Trump actually procedurally overturn all of that?
Well, I think that anyone who looked at those national security concerns did not think that they were things that could not be mitigated against. The CFIUS process allows for those mitigations. It was a political decision as much as a national security decision. I would say even more of a political decision than national security. So once you're able to get those mitigation procedures in place, it was always something that could get approved. It was just one of those things that it was at an uncomfortable time politically, and the Biden administration didn't want to have this approved and then lose Pennsylvania. But the problem for the Biden administration is that they blocked it, and they still lost. And they lost those Senate seats as well for Democrats. So it's just a real question as to why were they willing to kind of let that drag out as long as it did, letting this kind of come into fruition once Trump took office. I think it's one of those things, if you have a political problem out there, solve it as quickly as possible and move on, rather than let it linger and let those political ramifications take you under.
You started, Ed, by saying that the only thing that's constant is change, particularly when it comes to President Trump. It's helpful for people to understand what's driving that change. Is it political realities, whether it's in polls? Is it market responses to certain proposals? Is there a sense of what's causing President Trump to ratchet back some of his threats with both tariffs as well as potentially with blocking certain deals?
Yeah, Lisa, when I talk to folks that have been in and around him for trade, they say the driving force for him is getting companies to invest in the United States, in countries to come up with a agreement in terms of how much they will purchase from the United States, how much new market access they can get from the United States. And so I've always viewed this trade fight as a desire, one, to protect national security, two, get new revenue for the tax bill, and number three, see if you can use the force of the economy of the United States to get that change. And so when I look at some of these deals, it is a bit of a political reality, but it reflects what he likes to do. He wants to be able to say, at the end of the 90-day pause, I was able to sign trade deals, even though there'll be MOUs, not trade deals, with 100+ countries representing Y trillions of dollars of new purchases and X trillions of dollars of new market access. The dollar amount matters to President Trump. And if he can ring up the cash register, he views that as a political victory. That's his driving force.
Do you think we're blurring the lines, though, between accelerating American capitalism and central planning?
Yeah. That is absolutely going to be the truth, but it is going to be something that I want to have investors take a step back and say, all right, to the extent that you can get some of these deals, that's going to be positive. To the extent that we can count investments that were already going to be made towards that, can we move on with our lives is kind of really the question that I get from clients. As long as we know that Trump is transactional, I think a lot of investors feel that it is not ideologically driven. I think where we get the most concerns from investors here at Raymond James is when they think there's an ideology behind this that is not solvable. As long as there's some sort of capitalism behind that, people can adjust to that and get some level of comfort in this market that the trajectory here is positive.
Constructive framing, Ed. We appreciate it. Ed Mills there of Raymond James on a situation down in Washington. The president wants to make a deal.
Yeah, well, as long as there's some sort of capitalism behind it, people feel comfortable, evidently. Those were, it's a memorable phrase.
Happy to see that. Coming up next on the program, Frank Lee of HSBC looking ahead to earnings from NVIDIA, live from New York. You're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
2% rally on the S&P 500 just yesterday following a 4-day slide. This morning, slightly softer by not even 0.1% on the S&P and just about unchanged on the NASDAQ. With 3 hours until the cash open, let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Not a lot of drama underneath the surface either. We do have NVIDIA gaining 0.6% ahead of its earnings after the bell today. Now, it did have a really strong day yesterday, so taking a little bit of a breather from that big rally. Morgan Stanley calling this quarter a messy one after that announced $5.5 billion write-down of its inventory of chips that were originally designated for China, but now face those new restrictions. A lot of questions for NVIDIA, again, after the bell today. We also had a really strong day for Stellantis yesterday, up about 6%, which might be why we're down nearly 0.5% in the pre-market, but probably not what you want to see if you're Antonio Filosa. That is the newly appointed CEO of Stellantis. You'll recall the one before Tavares was pushed out. So many problems with this company, from demand to supply chains to EV stress. A long road ahead for that CEO. Again, those shares slightly weaker in the pre-market this morning. Finally, Booz Allen decisively falling down more than 2.7% this morning. Goldman Sachs publishing a note downgrading the company to a sell, saying that the government contractor sees limited potential for upside for things like revenue, given the fact we have had a pullback on spending from federal governments. Now, to be fair, the market already sees this. It's down 15% this year. And Booz Allen last week announcing it would cut about 7% of its workforce. John.
That outcome is very much by design in Washington, D.C. Danny, thank you. That stock is negative by 2.8% in the pre-market. On our radar this morning, NVIDIA, the stock to watch. The company reporting earnings after the closing bell. Investors waiting to see how export restrictions to China impact the chip makers' bottom line.
Yeah, how do they give any visibility at a time where policies have been changing? They did have a chip that was designed specifically for China. That was a designation that was essentially revoked by the Trump administration. You raised an interesting point. It's not just the question of demand, it's also supply, and whether they are seeing supply chain disruptions or any kind of fissures just because of some of the trade negotiations that we've seen going on.
Morgan Stanley said there's simply no offset to this, and already we've seen the company have to take more than $5 billion write-down for these chips, which is really astonishing. They designed to get around other export controls. They were supposed to be compliant. The Trump administration in April said you're going to need a license indefinitely to send these H20 chips to China, basically, which means none of them are going there right now. And if there's no offset coming from the Middle East, where else will there be an offset? This is a real challenge for them.
We'll get the view from HSBC in just a moment. As Lisa pointed out a little bit earlier in the program, a 44% rally off the April low on this stock. I want to turn to this story. The U.S. government set to receive a so-called golden share in the U.S. Steel Nippon Steel deal. Sources telling us here at Bloomberg the agreement gives the government de facto veto rights on certain decisions and appointments.
So basically, it is a golden branding opportunity for the Trump administration to try to get this through with some, as Ed Mills called it, political cover. So this golden share, we still have a ton of questions more than answers, but basically what this would allow it to do is more U.S. board members could be on part of the company. They would allow veto to things like production cuts. If there is national security concerns about supply chains, the U.S. government would have potentially this veto. Actions like offshoring, shutting down productions line, all of this potentially the U.S. government would have a say. Is that going to be enough political cover, though, for a man that ran basically on saying this deal will never get through if I'm the Oval Office?
It looks like that deal is going to get through, that's for sure. I want to finish on this. Elon Musk having his say, pushing back on President Trump's tax bill, the tech titan saying it undermines the Doge team's efforts to cut government spending while increasing the budget deficit.
Is this an apology tour or maybe just a distancing tour at a time when Elon Musk is trying to turn the focus back to his companies? I find the fact that he's saying this now interesting, given some of the issues that he's having with some of his portfolio companies that he wants to focus on. How much is he actually going to hold clout with the president and, frankly, senators who might agree with him? And how much is this a personal branding opportunity to say, look, I had an effort, it wasn't part and parcel with the whole administration. Don't blame me for everything there. Buy a Tesla.
The timing is also off on this. If anything, you would need Elon Musk running Doge right now to offset those concerns a lot of people have when it comes to the one big beautiful bill, which basically was started only in January because, remember, there was this huge debate between the upper chamber and the lower chamber if we just do a separate tax cut policy along with an immigration package. And Trump said, enough of this, just put it in one big beautiful bill. Elon Musk, though, is seeing how much actually Washington likes to spend, whether it's Republicans or Democrats, just like to spend on different things.
What did he say? It could be big or beautiful, it can't be both?
Yes, because basically Elon Musk is saying for it to be beautiful, it needs to be smaller, it needs to cut the deficit.
That's the latest in the nation's capital. Let's turn back to tech. Investors bracing for NVIDIA results after the closing bell as China export curbs weigh on the chip maker. Joining us now to look ahead, Mandeep Singh of Bloomberg Intelligence. Mandeep, welcome to the program, sir. What are you focused on later this afternoon?
Well, we know that China is the focus, but for me, gross margin is where we can determine, NVIDIA's pricing power. And right now, everyone is fixated on power supply. 6 months back, everyone was fixated on supply of GPUs. I feel that concern has alleviated and the focus is more on power. And so what I want to know is how does that affect NVIDIA's gross margin in terms of supply concerns abating? And look, the geopolitical tensions are still there. They may have to move some of their supply chains, but in the end, it comes down to gross margin because that's the biggest determinant of NVIDIA's free cash flow.
There's also a question, Mandeep, about the hyperscalers that have come under some unique pressures. I'm thinking of Google or Alphabet, the parent company of Google. How much do you expect some of these companies to increasingly become competitors, not just customers, and for that to be part of the narrative mix stemming from earnings today?
Absolutely. I mean, look, we know NVIDIA's revenue is concentrated with the 5 big hyperscalers. And we also know OpenAI is trying to branch out on its own when it comes to building its data centers, et cetera. So from that perspective, the commodification of LLMs. So if Gemini is catching up to OpenAI, that's bad news for NVIDIA. And look, for NVIDIA, clearly they want the LLMs to standardize on their chips, but there are a lot of alternatives emerging, especially in China. And if, Chinese aren't getting the supply of GPUs and they're still able to train the models, they are setting up a precedent that you can do inferencing without NVIDIA GPUs. And that is what will determine in this AI infrastructure supercycle what sort of market share will NVIDIA have 2 years from now or 5 years from now.
The stock is positive in the pre-market by 0.6%. Mandeep, appreciate your time. Mandeep Singh there of Bloomberg Intelligence to build on the conversation. Joining us now, Frank Lee of HSBC, who has a hold rating on the stock and a $120 price target on NVIDIA. Frank, welcome to the program. I just want to build on some of the conversation we've already had so far this morning and understand from your perspective why this won't be the beat and raise quarter that maybe some people got used to in years gone by.
Yeah, I think if you look at the beat and raise, we haven't really seen that for the last couple of quarters of NVIDIA since the second half last year. So I think what you're seeing is that, and one of the reasons I think we see is that there's still some ongoing challenges they're facing this year, which they didn't face last year. Number one, you had, the supply chain is still having some ongoing issues, especially on the downstream side and the way they ramp their NVIDIA rack architecture. We've had the China ban come through earlier as well. And also, I think the GTC roadmap that was launched, it wasn't as exciting as people had hoped. We're not seeing a huge spec migration that will drive this incredible pricing power going forward. So these, I think, were the headwinds that I think NVIDIA is facing in the first half of the year. And I think as you go into earnings, I don't think there will be a major surprise. I think the market has gotten used to that already. Expectations for the revenue has come down over the last 3 months. So I don't think there will be a big disappointment either. So I think the focus, though, will be probably as we go into 2026.
There's a question, Frank, about the supply side of this story with respect to supply chains and other issues just creating enough chips to really meet demand. And then there's a question around the demand and how much is coming from China versus the Middle East versus hyperscalers. Which side of the equation do you think is going to be the more important one this earnings season?
I think the focus will be, the narrative somewhat has actually changed quite a bit, especially after I think the Middle East AI deal, because that represents a new greenfield market opportunity for NVIDIA that, over the long run could perhaps double their revenue from where we are today. So I think that has been probably the biggest change, the big reason why the stock has rebounded off the recent lows. However, I think, to get confirmation that this demand, from the Middle East will materialize, we're going to have to see between now and end of the year whether the supply chain expectations for next year does continue to reverse. Because since the beginning of the year, what we've seen is that, the capacity on the chip side allocation has been coming down. So does this trend start to reverse as we get into next year? That will be seen as a very important indicator. We may not see that for another couple of months, but that will be something I think is really critical because that establishes your baseline for 2026 that it can grow again. Because I think prior to this narrative, it was just really the hyperscaler capex will slow, and they will also see more of a focus on their own chip, the ASIC chip, and that's why we see Broadcom seeing a very strong growth for next year as well.
Frank, it was a pretty remarkable moment in a photo op when you have Jensen Huang basically standing in between President Trump and Sheikh Mohammed bin Zayed in Abu Dhabi when they signed this AI partnership. But whether you put all of these deals together across the Gulf, is it enough of an offset for what's happening with China?
I think right now, the narrative clearly is there to suggest that it is. I mean, they've talked about 600 gigawatts that potentially over the next 10 years or so could double their revenue to 200 billion. But that's the narrative. Whether it materializes or not, we'll have to see. I think, again, as we see next year, that the supply chain start to see upward revisions. We've been in a downward revision since the beginning of the year. Now, does that start reversing course? I think that will be an important thing to see because that's going to be the most, I think, a very important driver for NVIDIA next year. The hyperscaler will slow down. I think they know that. And I think they've been preparing for that, which is why I think at Computex, Jensen also talked about, willing to sell the networking chip, so he doesn't have to buy, the hyperscalers don't have to buy the complete solution from him. So I think he's become more open-minded about selling, other chips besides the entire solution.
Frank, just to wrap it up, we'd love a thought from you on the man himself, the leadership, Jensen. Tim Cook, increasingly out in the cold at the moment with regards to the relationship with the President of the United States. What is Jensen doing right?
Yeah, I think it's an interesting one because Jensen clearly has expressed desire to continue to sell into China. He's been very vocal about it. In fact, I think, they are working on another chip that they plan to sell into China that can I guess get around some of the restrictions we're seeing today. But on the other hand, I think he's also quite supportive of the loosening of AI diffusion. The deal in Saudi Arabia, I think, was a good start. So I think he's also been very supportive and appreciative of the administration about going in that direction.
Frank, given his pursuit of China, though, and China as a major customer, do you see tension down the road between the two individuals?
I think, what NVIDIA has proven to be is very adaptable. So they've been, every time there's been a restriction, NVIDIA has abided and followed it. They just come up with another chip that basically falls below the criteria benchmark. And so I think he will continue to do that, but again, in a fashion that I think is pretty much well telegraphed. So I don't see it as being a negative source of tension. I think, he still doesn't want to give up on the China market, but at the same time, I think he's also looking to follow whatever the restrictions are placed, and he'll find ways to meet them. So.
Got it. Hey, Frank, appreciate your time. Frank Lee there of HSBC on NVIDIA. Earnings from them a little bit later this afternoon. Jensen Huang's really navigated this situation well, the tension between the US and China.
It also helps to have something that everybody wants, and that can be the key to a lot of deal negotiation. And I wonder how much some of this is part and parcel with trade negotiations, geopolitical negotiations. It is a convenient person to have by your side for Donald Trump.
Are you saying we don't want iPhones anymore?
I'm saying that there's more competition. I'm not saying that we don't want iPhones, but I think that that's an important question. Is that less of the gold chip that you might be getting from the likes of an NVIDIA chip?
Without a doubt. NVIDIA this morning in the pre-market positive by 0.6%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira. Hey, Yahira.
Hi, John. President Trump warned Vladimir Putin in a social media post that he's, quote, playing with fire. The U.S. is deciding whether to hit Moscow with additional sanctions after it launched its largest ever drone attack on Ukraine. Trump also wrote that if it weren't for him, lots of really bad things would have already happened to Russia. Meanwhile, Nissan is seeking an urgent turnaround plan as it faces a looming debt crisis. Sources telling us here at Bloomberg, the company plans to raise over $7 billion from debt and asset sales, including selling part of the 15% stake it owns in French carmaker Renault. This all meant to address a huge loan repayment due next year. And round 2 of the French Open is underway. Novak Djokovic, Jannik Sinner, and Carlos Alcaraz all won their first round matches with ease. Meanwhile, top-ranked American Taylor Fritz and Russia's Daniil Medvedev were among the players to suffer upsets. In the women's tournament, defending champion Iga Swiatek and world number 1 Aryna Sabalenka both take the court later today in separate matches. That's your Bloomberg Brief. John?
Very cool. Yahira, thank you. Thank you very much. Up next on the program, King Dollar's reign.
There's literally no alternative to the US dollar and US assets from 6 months ago. Dollar was overvalued, dollar assets were over-owned. There's a vulnerability in search of a trigger.
Up next on the program, Ishwar Prasad of Cornell University, live from New York City. This is Bloomberg.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Equities turning positive in the last 15 minutes or so. Equity futures positive by almost 0.1%, up by 0.2% on the Nasdaq 100, with earnings from Nvidia in focus a little bit later on this afternoon. And a surveillance this morning, King Dollar's reign.
There is literally no alternative to the US dollar and US assets from 6 months ago. There's still no massive, huge liquid alternative, but there are some other kind of currencies and countries kind of popping their head up. The dollar was overvalued, dollar assets were overowned. There's a vulnerability in search of a trigger. It's just going from extremes in valuations, and there is no other place to be to, well, hang on, maybe I can reallocate to some other places.
So here's the latest this morning. President Trump's policy stoking concerns about the dollar's dominance. Ishwar Prasad of Cornell University writing the dollar's dethroning is unlikely. Luckily for the United States, and unfortunately for the dollar's detractors, there appears to be no competitor strong enough. Ishwar joins us now for more. Ishwar, welcome back to the program, sir. It's always good to get your thoughts on Bloomberg's surveillance. Let's take it from the top. What's the difference between diversification and de-dollarization?
So the two could very well be related, John. What is the reality the world faces is that if you're holding, more than 57% of your assets, that is reserves, in one currency or one asset class, you really should be diversifying, which is something that the world has been trying to do for a long time. So there are very good reasons to step away from the dollar. Now, the issue, of course, is that the dollar is very important, not just as a reserve currency, but as a payment currency, as a funding currency. And in all of those respects, the reality is that there simply isn't another currency that can outmuscle the dollar. Certainly a world in which there were multiple currencies that were competing on an even basis might be a more efficient world. It would create more discipline and more incentives for discipline from the issuers of those currencies. But that's not quite the world we live in right now. And the weaknesses of the other currencies are still keeping the dollar in pretty good shape.
Well, let's talk about some of those weaknesses. It feels like for many that China is just a non-starter because of the lack of capital mobility. What about the Europeans, Ishwar? Where do they fit in?
That would be a very logical alternative to the dollar. In fact, when the euro was created in 2000, there was an upsurge of excitement about an alternative to the dollar finally, and the euro did seem ready to fulfill those promises. In the first 7 to 8 years after its creation, the share of the euro in foreign exchange reserves, for instance, went up by about 8 percentage points, from about 20 to 28%. And there was a sense that the euro was an unstoppable linear path to taking over from the dollar. But then it all ended. The global financial crisis and the Eurozone debt crisis revealed that Europe does not quite have all the elements of a monetary union. Yes, there is monetary union, but the true banking union, the fiscal union, and other parts of economic union did not really hold together. So if you think about the core part of the Eurozone, countries like Germany, Austria, the Netherlands, and so on, that's a much smaller share of the overall Eurozone bond market. And even those core countries are not exactly doing very well right now. Germany is struggling, for instance. So it doesn't look like Europe is ready to step up and take on the mantle. And certainly since 2008, the euro has done very poorly. Its share as a payment currency, its share as a reserve currency have all fallen back to about the pre-euro levels.
This is the institutional weakness that you're talking about that leads the dollar to remain on a much longer leash than any currency should rightfully have. That's your words. At the same time, the dollar is still on a leash. And Steve Englander of Standard Chartered said overnight that a U.S. dollar and rates crunch could emerge if the fiscal bill steepens the debt path without boosting growth. How much do you see that as a possibility, say, in 2026 or 2027?
You know, by all logic, Lisa, the dollar should not be where it is. We are seeing that macroeconomic policies in the U.S., especially the fiscal deficit and debt levels, do not show any real discipline by U.S. policymakers. The key elements of the institutional framework that are crucial to underpinning the dollar's dominance, you know, the independence of the central bank, the Fed, the system of checks and balances, the rule of law, all of these have certainly taken a pretty strong beating. But the reality is that if you put the whole package together, the institutions, but also financial market depth and size, and the dynamism of the U.S. economy, even if the U.S. does very poorly in each of these dimensions in a relative sense, it's still doing better than the rest of the world. And that's a difficulty. But having said that, we have certainly seen a fall off in the dollar's share of global asset flows and so on in the last 4 to 5 months. But it's worth keeping in mind that from September of 2024 to about January of 2024, just till about Inauguration Day for the new president, the dollar on a trade-weighted basis rose by about 10%, possibly making it quite overvalued. And then it's fallen back by about 10% to about where it was in September 2024. So if you want to tell a very negative story about the dollar, you start in January. If you want to tell a different story about the dollar, that things have changed, but not really in a fundamental sense, you go back to September 2024 and not that much has changed.
We know the president hates trade deficits. Do you think any of this is strategic to boost U.S. exports?
That's a very interesting question. We've heard very mixed messages from the administration about whether they want a weaker dollar in the short run and a stronger dollar in the long run. Trump certainly has spoken about how he wants the dollar to remain the dominant currency, but at the same time, in many of the issues that we've had with other countries, including countries that the U.S. is running the U.S. is running a trade surplus with, the Trump administration has argued that many of those countries are manipulating their currencies to keep them weak, suggesting that the U.S. would prefer that those currencies be stronger and the dollar be weaker. That mixed messaging certainly should be hurting the currency, and it probably is, but it doesn't seem to be a fundamental aspect of policy that they're trying to weaken the dollar through the messaging, but certainly the policies they're putting in place, the increased likelihood of a U.S. recession later this year because of all the tariff troubles, the increasing fiscal deficit levels, all of those are certainly going to weaken the dollar.
I have no doubt this is going to be an ongoing conversation, particularly with you, sir. Ishwar Prasad there of Cornell University, doing a wonderful job of breaking this down. DXY. Dollar index, heavily weighted, of course, to the single currency, the euro, but worth tracking. 5-year average, 100. This morning, 99 handle. That tells you everything, I think. There hasn't been that big of a change in a historical perspective. You have seen an incredibly elevated or strong dollar in the past couple of years, and so how much is just a reversal of that? The key question, though, how much is the goal to get a weaker dollar? And Anne-Marie, you touched on this. In order to boost exports, unclear. They're not willing to confirm that, but a lot of people are speculating that could be part of the case. Which is why we're seeing these moves in gold. One of the reasons, anyway, up 26% this year, up 27% last year. The rally continues. There is a search for an alternative. Seem to have coalesced around one that's very shiny and that's very heavy and very hard to put in your suitcase. And yet it doesn't seem like that's actually becoming a replacement, but rather more of a hedge. Gold this morning up by 0.4%. Up next on the program, David Lebovitz of JP Morgan Asset Management, Monica Guerra of Morgan Stanley, Congressman French Hill, and Marissa Adams of HSBC. The second hour of Bloomberg Surveillance is just around the corner.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What would it mean for India to host the Olympics?
Heslinda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
You've hit the peak of tariff uncertainty.
The damage has really been done in terms of supply chains. There is so much volatility.
There's just so much political uncertainty. The issue is right now we're really waiting and hinging on what the administration does with trade.
I'm not minimizing the impact of tariffs, but it's right now we've been trading like it's all there is to the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Triple header in the last 24 hours or so. Better news from Japan on the debt market, better news from the president on trade, and better news as well on the consumer in America. Consumer confidence bouncing back, leading to a 2% gain on the S&P 500 this morning. We add just a little bit of weight to that. Equity futures up just a touch on the S&P 500, positive by 0.1%. On the NASDAQ, up by 1/4. The NASDAQ 100 in focus later on this afternoon. We'll get earnings from NVIDIA. NVIDIA in the pre-market, positive by 0.6%.
So there's so many different overlapping stories. On one hand, you have consumers feeling a lot better, at least according to the conference board data yesterday, because there has been a walking back of some of the trade tensions. Do you see that same sort of relief in the NVIDIA earnings today about the walking back of trade tensions that have led to a decoupling, no, trade, yes, with China, and just where they go from here as they try to replace demand, not necessarily with China, but from the Middle East?
We spoke to HSBC a little bit earlier on this morning, not expecting the beat and raise beat and raise later on this afternoon. Their focus, the big question for a lot of people in this market this morning, how are they going to navigate the restrictions and meet that demand in China?
HSBC thinks that potentially this Middle East demand could offset China. But right now, as Frank talked about, this is just the narrative that's playing out. These are the photos that NVIDIA wanted to portray on the Trump's Middle East trip. You asked him a great question. How is NVIDIA navigating all this? Well, he's tethering himself to Donald Trump and tagging along every single stop of his Gulf tour. NVIDIA, we've seen so far with the Trump administration, has had one loss, the H20 limit in China, but had one huge win. And this was the diffusion rule. When I spoke to Jensen Huang a few weeks ago in Washington, D.C., quickly before I went to see President Trump, the animosity he had to the diffusion rule was palpable. So we'll see how he goes forward and whether or not it's even worth them developing a new China chip.
The stock is up in a pre-market by 0.7%. Look out for a conversation with Jensen Huang later on this afternoon between Bloomberg's Ed Ludlow and Jensen Huang at 6:30 Eastern Time. I want to talk about the bond market briefly as well. Yields higher today, lower yesterday. Yesterday, better news out of Japan, a signal from the Ministry of Finance that maybe they'd tweak long-term debt issuance. Why? Because when they issued long-term debt issuance today, it didn't go so well on a 40-year maturity. We get some U.S. supply later this afternoon.
We've got 5-year notes today and 7-year notes tomorrow. Overnight, the 40-year bond sale, even after the soothing rhetoric from the Ministry of Finance, had the weakest demand ratio going back to July of 2024. How do you understand the bond market right now? I mean, not to get existential on a Wednesday, but there's this feeling of what is driving it. I mean, if the Ministry of Finance in Japan can't really help things by adjusting supply, are people looking at inflation? Are people looking at the fact that there are only 2 buyers left of Japanese bonds because the Bank of Japan owns them all? I mean, how much are we looking at actual economic dynamics versus supply-demand dynamics? It's a question.
All of them are the above, and not just in the United States. I think Japan is a big feature of that conversation. Debt issuance in the US will be too, particularly what's happening down in Washington, D.C. Elon Musk in focus, pushing back against the president's tax bill in the nation's capital.
And we've heard that as well from senators, where this bill now is going to be sitting with the Senate, and some of them who think that this just spends too much, but it delivers on the president's priorities along the campaign trail. No tax on tips, no tax on overtime, things like that. Is delivering on these promises that he wants to keep. What Elon Musk I found so fascinating is the bill can be big or it can be beautiful, but Jonathan, it can't be either.
Yields right now up by 2 basis points on a 10-year. The 10-year at the moment is 4.46. On a 30-year up by 2 or 3. Let's call it 4.98. Coming up this hour, David Leibovitz of JP Morgan Asset Management on a policy-driven market. Congressman French Hill on President Trump's big, beautiful bill, and Marissa Adams of HSBC as trade tensions reshape corporate strategies. We begin this hour with stock steady after snapping a 4-day losing streak. David Leibovitz of JP Morgan Asset Management writing, markets remain a prisoner of U.S. policy. While we've reduced our equity overweight in aggregate, we maintain our preference for markets outside of the United States. David joins us now for more. David, good morning to you.
Good morning.
That diversification, that regional diversification, why are you sticking with that story?
So when we look at what's going on with the world, we recognize that policy is the fly in the proverbial ointment. But we do, we have begun to see that, a lot of what people, I think, misunderstood as not being a negotiation tactic actually is a negotiating tactic. And you saw it with Europe over the weekend. You've seen it with China. You've seen it with the UK. And so the way we're thinking about being invested today is we don't necessarily want to subject ourselves to too much policy-driven volatility, but we do believe that the probability of recession has come down meaningfully relative to where it stood at the beginning of April. And so it's really about keeping one foot on either side of the line, having some exposure to risk assets to capture that upside as it materializes, but not having so much risk exposure that the market just moves you around as the headlines dictate the direction of travel.
Yeah, there's a numbing effect. I mean, yes. I feel like at a certain point you start to wonder how much can we really care? And you saw that over the weekend with really muted price action, even with the threatened 50% tariff on European goods. And then at walking back of it, people are like, okay, here we go again. How much can you move past that and look to other catalysts instead of being prisoner to these whipsaws?
Well, what I think is interesting is that you're seeing the market shift its attention towards other, let's just call them pain points for lack of a better term. What's going on with the bond market with respect to the auctions? What's going on with fiscal policy down in Washington, D.C.? It feels like not only the administration but investors are trying to move the trade conversation off to stage left and focus the spotlight on other issues that we know are going to be relevant as we move into the end of the year. And so I think they've said, you know what, trade, it's going to be what it's going to be at the end of the day. Let's focus on other issues where we may have a bit more clarity, and things like supply supply and demand, like you were saying, maybe a bit more of a dictator of the direction of travel.
So which is it within the other buckets, away from trade, since it's so hard to quantify? Is it the supply-demand dynamic with some of the fiscal spending in the bond market, or is it the question of the economic ramifications of some of what we're seeing? I have to mention with trade, but also with some of the fiscal retrenchment that we're seeing from the U.S.
So I think at the end of the day, the way the market is thinking about this is the trade issue is not going away, right? We're going to have tariffs. They are going to be higher than they were at the start of the year. How much higher? Time will tell. The drag from tariffs, though, continues to be pushed out. And what I think the administration is trying to do today is play more of a timing game where if they continue to kick the can on the tariffs towards the end of the year, then the impact on the economy only shows up as you're getting that fiscal thrust in 2026. That's what I believe their plan is. Now, you need to get that timing pretty right in order for it to work, but there is still a narrow path here towards, a better outcome than I think markets are expecting in the base case.
In Trump's first administration, the phase one trade deal negotiations, USTR coming out, that started in 2018. They inked a deal in January of 2020. These trade headlines are going to basically be an overhang on the market the entire 4 years, right?
4 years, potentially. We'll see. It's going to be an overhang for a while. And I think you make a very good point, which is not only did it take time for actual policy to be implemented, but then it takes time for it to show up in the economic data. And everybody who was looking for a soft patch in the third quarter of this year with respect to U.S. growth probably isn't going to see it materialize to the extent that they had anticipated. I think, again, it's going to be more drawn out. That helps smooth the impact from the tariffs overall. And if we are in the process of trading the stick for the carrot and moving more towards fiscal, that could obviously be a net benefit when we get to next year.
But if these trade deals take months and years, what do you make of people coming out and saying we're over peak uncertainty with trade?
So I think that's a fair statement in the sense that, they fired the bazooka and now they're firing cannons. It's a little bit more of a muted approach to negotiating trade policy. The big bang has already been seen, and that's why I think people make that comment. What I think is interesting, though, back to your point earlier, we're trading one uncertainty for another. Right, we're trading trade uncertainty for policy uncertainty and debt market dynamic uncertainty. And frankly, I think those are a little bit easier to digest because there are hard facts and figures that underpin a thesis surrounding those two items.
Is there a price to pay for the volatility of the past 2 months?
So I think that there definitely is a price to pay for the volatility. I think we all have a few scars that we were showing off at the pool over Memorial Day weekend. That's part of why we continue to lean into credit within portfolios. We like the fact that, again, it gives you that upside exposure if things end up being a bit better than expected. You've got a third the volatility of the S&P 500, and you're clipping a coupon of around 7%. And so it's about managing through the volatility rather than running to your bunker and hiding just because volatility has been high.
I think the question the data yesterday introduced, the soft data, the consumer data, is whether actually the soft data might catch up to the hard data instead of the hard data catching down to the soft data. How much confidence would you have in that?
I think that's a fair stance to have in the current environment. I don't think that there's going to be no impact on the hard data, but I don't think that it's going to soften quite as much as what the soft data had previously implied. You can see the resilience coming through, particularly on the consumer side of things, and even on the business side of things. The durable goods report yesterday was very noisy because of what's gone on with aircraft shipments over the past couple of months. But when you hear what businesses are saying, they're not abandoning CapEx that they've already started. No, they're not ramping up investment spending either, but everybody's just kind of standing pat. And I think that's the point that a lot of people might be missing, is that as we retreat from peak uncertainty, as people have a better understanding of what the playing field is going to look like going forward, they're going to be able to make more informed decisions, right? And if there's one thing that the U.S. economy is, it's dynamic. We saw that during COVID, and so adjusting to the state of play is something that I frankly think we're pretty good at.
I love the way that you frame this, the two buckets of risk, the idea of the fiscal overhang versus trade uncertainty, and the fact that it's by design that these two have an interplay where you shift off trade uncertainty for a while until fiscal can come into play. How does that feature into where you see opportunities, maybe in companies or in sectors that people have underestimated how much resilience there actually will be based on pushing off some of these trade tumultuous moments?
So I think a couple of parts of the market look interesting today. One, we continue to see value in things like technology and communication services. The re-rating and valuation that was observed over the past 6 or 7 weeks was fairly substantial. And so, we're paying a better price. We think the earnings are going to be there. Sure, there's a lot of hype around AI, but it's not something that's necessarily going away. And so comfortable leaning into those growthier parts of the market going forward. The other area that we continue to like is financials. And I think financials are very much underappreciated because we're not talking about one of the other carrots that the administration has dangled, which is the prospect of financial sector deregulation. We were speaking to people during our most recent strategy summit about the state of the financial industry. Are banks ready to lend? It sounds like if they are able to reduce the capital charge significantly or sufficiently, that will open the spigot and really get credit flowing in the U.S. economy, which will just be another tailwind to the overall pace of growth.
David, lots to chew on. Appreciate your time, as always. David Levitz there of JP Morgan Asset Management with equity futures positive by 1/10%. Stephen Stanley of Santander with this to say on the data yesterday. The book is far from closed on tariffs, but financial markets seem ready to move past it. And these numbers suggest the households may be moving in that direction as well. Equity's doing better in the last 24 hours. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Yahara Arnott. Hey, Yahara.
Hi, John. Macy's shares are higher by 2.5% in the pre-market after the company reported better than expected first quarter results. The retailer maintained its full year sales outlook despite projected tariff impacts, citing its range of merchandise as a key factor. The numbers underscore Macy's efforts to focus on its best performing locations and close struggling stores. Meanwhile, the U.S. government is poised to receive a so-called golden share in U.S. Steel as a condition for allowing Japan's Nippon Steel to acquire the company. Sources telling us here at Bloomberg, the plan would give Washington de facto veto rights on certain company decisions. President Trump announced a partnership between the two companies that included $14 billion in new investments in the U.S., but provided few details beyond that. And Elon Musk will face a lawsuit over his work at Doge. More than a dozen Democratic state attorneys general brought the case, saying Musk wielded illegal power in orchestrating President Trump's cuts in federal government jobs and spending. The judge said the administration adopted a perverse reading of the Constitution with the Doge effort. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the first buddy breaking with the president.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Doge team is doing.
Up next on the program, Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities up yesterday, up again this morning, just a touch. We're up by 1/10% on the S&P 500. On the Nasdaq, going into earnings from Nvidia later on this afternoon, the Nasdaq 100 positive by 0.2%. Under surveillance this morning, the first buddy breaking with the president.
I was disappointed to see the massive spending bill, frankly, which increases the budget deficit, not just decrease it, and undermines the work that the Doge team is doing. I think a bill can be big or it can be beautiful, but I don't know if it can be both.
Here's the latest this morning. Differences between the president and Elon Musk emerging as the Tesla CEO scales back his work with Doge. Joining us now from Washington is Bloomberg's Tyler Kendall. Tyler, how much do the words of Elon Musk carry weight in the Senate with some of the fiscal hawks out there at the moment?
Yeah, hey, John. Well, it's likely welcome news for the likes of Senator Ron Johnson, a Republican from Wisconsin, considered to be probably the loudest fiscal hawk at the moment, advocating for changes of this House bill. In fact, you had the senator in an interview over the weekend claim that he has enough support to ultimately hold up this bill. But at the end of the day, I have to say, I was on Capitol Hill a lot last week, and the prevailing sense seems to be that front-loading tax cuts will take priority over the spending cut offsets. You already have a range of senators raising concerns about what these spending cuts could look like when it comes to changes to Medicaid and rolling back those clean energy tax credits under the IRA. Now, the CBO their latest analysis, which does not include the final changes to this bill, and we should say the White House broadly disagrees with their methodology, but it says that this House bill would add about $3.8 trillion to the deficit over the next 10 years. And John, that's before taking into account that Senate Majority Leader John Thune has indicated that they want to make some of those temporary tax provisions permanent going forward.
Tyler Kendall in Washington. Tyler, thank you. To build on those words, on that exchange, Monica Guerra of Morgan Stanley joins us now for more. Monica, good morning.
Good morning.
So we've got the bill that came out of the House, and ultimately we'll see a bill that comes out of the Senate. How wide is the spread going to be between the two?
I think we still have a lot of time to see, but what's interesting is not just a disagreement on how much you're going to add to the deficit, but also which programs are they going to actually look to. So is it IRA spending? Because you have red states that are reliant on some of those tax credits. Is it Medicaid? You know, there's lots of different areas in which they can look to cut and sort of move the needle here. And one of the things that, Elon Musk mentioned, right, is that there's this disappointment that he has that they're still adding to the deficit. Well, if you're going to have significant tax cuts extended, there's really only one way to make up for that difference. Either you cut, significantly from other programs, which is not on the table, or you go to raise revenue, right? And so that is sort of the hard decisions that Congress is trying to make right now.
Are either of those options on the table when it comes to the upper chamber?
Not on the tax front, right? They're going to have to look for room on the margins. Now, I think you're going to look to adding about $2 to $3 trillion at the end of the day to the deficit. And the way that they could message this is they're reducing deficit spending, so not the actual deficit. And they're going to have to lean into that narrative because no matter how you shake it at this point, they're going to be adding.
Let's get into some of the potential problems. Senator Hawley, Susan Collins, Ron Johnson, who Tyler just mentioned, Medicaid, green energy tax incentives, overall spending. What do you think is going to be the biggest fight when it comes to this bill?
Well, right now it sounds like the fiscal hawk perspective, and each sort of priority is going to get their moment in the sun as they go through these negotiations. But at the end of the day, the thing that markets are going to be looking to is what does that mean for term premiums? Right? Is it we going to get additional pressure because the debt and deficit are out of balance? And so that's something that we have to watch, from a markets lens.
There's a difference between just having a deficit that goes up versus something that really does generate growth, and how much of what we're seeing right now in the proposal is stimulative versus actually contractionary in terms of some of the programs that are being cut.
So the stimulative pieces we think are actually going to come in 2026. What we have from the tax cuts piece is really an extension of status quo. You do get some wiggle room on CapEx, on R&D, right, as far as different tax incentives for more of the growth side, right, of the economy. But that actually dovetails really nicely with potential deregulation and fiscal spending for things like data centers, AI, potentially clean energy, you know, if you're thinking about other, you know, I would say on the growth sector winners.
How much risk is being foisted to the states, to specific states? You talked about how certain programs, if they get cut, have a disproportionate effect on specific regions. Just how big is that disparity? What are you seeing there?
Yeah, so it's not just the federal deficit. It's also at the state level. So our head of municipal research, Mark Schmidt, he's put out some great work on this, really highlighting that credit spreads are likely to be pressured for nonprofit healthcare, especially if you get that Medicaid cut. And that's really on the single names and rural hospitals, but then also at the state level. If you're thinking about the way that states are going to have to step up and carry some of this burden, because people still need health care, regardless if you cut their benefits or not. And so you have to look to states that have, you know, an imbalance with their general fund and reserves. And places you could look to would be California. New York would probably, weather the storm well, but also some rural states that may see an influx of folks who are rolling off Medicaid in addition to the cuts.
Are you starting to see that market impact already play out?
So where we're seeing it is actually more in the non-for-profit healthcare space. Now, with states, they're a much slower moving juggernaut. And so that really you have to wait until the end of the year, see how they, you know, all their tax revenues come in, et cetera. And then it becomes a question around how much pressure they're going to have to build. So really where you're seeing spreads tighten is around non-for-profit healthcare and other municipal categories.
Will tariff revenues offset any of this?
Tariff revenues, you know, the idea is that they will offset, at least from the federal component. Now, do the states benefit? Not directly, right? Because if you're thinking about how tariffs are paid by the business owners, that goes directly to the federal government. So you're not going to see a revenue boost from tariffs directly to the states. So that is a no-go.
There's one part of this bill we haven't discussed yet, which I think is important, because it could be on the chopping block, and that's the 40,000 new cap when it comes to salt. Do you think that stays?
I think you get maybe a reduced level. This is something that you have to remember that they're going to go to a conference over. So you're going to have House leadership and Senate leadership together trying to get all these disparate goals and realign around them. So maybe we end up at that 30,000 where we started. That would be, I think, in the realm of possibility.
But does a Mike Lawler or Lee Stefanik have a single friend in the Senate when it comes to keeping the tax deduction higher?
Though I don't know the inside baseball on those relationships. I want to be clear about that. But what I do know is that they really were holding up the process in the House. And if you want to get full consensus around this and have something sent in a timely manner to the president, there may have to be some concessions made. I'm not ready to call that it's going to be completely off the table yet.
Do you think it gets done by July 4th?
I think you get a blueprint by July 4th, so no.
Okay, Monica Guerra there of Morgan Stanley. That's certainly the goal, to get this wrapped up by Independence Day.
And that is directly correlated to the July 9th, also deadline for some of these trade negotiations, because these are part and parcel to offset one another, which really raises the question, how stimulative is this bill going to be on the fiscal side, and will it be quickly enough to offset some of the hit from some of those tariffs?
Yeah, and one thing we've explored on this program over the last few days, whether that bill, if it does get signed by July 4th, emboldens the president to go harder on some of the trade issues too.
Well, potentially. I think a lot of this, we also have to remember, we've seen the president have these reprieves when it comes to trade, depending on the pushback on the market. So I think you want to see where the 10-year yield is trading on July 5th. I think we're off that day, whatever day we're back on air, and where the markets are, because that has been actually a pushback when it comes to how far he's gone on the tariff front.
And to figure that out, you might have to look to Japan. Overnight, 40-year debt issue out of Japan, coming in a bit weaker than expected, triggering a bit of a sell-off in treasuries. Yields are higher by some 2 basis points on a 10-year, up by 2 on a 30-year. Later on, some issuance, the 5-year, onto tomorrow, the 7-year. That's the debt situation. In the equity market, the focus on NVIDIA earnings after the closing bell, with equity futures on the S&P 500 just about unchanged. Jensen Huang seems to be the man of the moment. What will the numbers look like later?
And how much can he message in this conciliatory fashion that the trade uncertainty is not bothering him? He's okay with it. If you don't want my H20 chip, I've got an H25 chip or whatever else the new thing is going to be, and really push forward this sense of leadership in the chip sector.
Jensen Huang on Bloomberg TV, 6:30 p.m. Eastern Time, sitting down with Bloomberg's Ed Ludlow. Look out for that. Up next on this program, Congressman French Hill, as President Trump's signature bill faces more hurdles. From New York, this is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Snapped a 4-day slide on the S&P 500 in yesterday's session, a solid gain of 2% to kick off the trading week. Equity futures just a touch higher, an inch higher, up by not even 0.1% on the S&P. With 2 hours until the cash open, let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. We had some retail earnings in the past hour. Let's go through them. Dick's Sporting Goods, one of them, up 1.3%, a quarter where they basically reaffirmed everything that we got from them earlier this month. That's enough, though, to send shares higher. Really, the concentration, though, for Dick's has been their acquisition of Foot Locker, which is why they pre-announced. They announced that deal and what the results would be, where they keep their outlook the same. That's really going to be the concentration of that call. What Dick's Sporting Goods looks like with Foot Locker Walker now in tow. Now, we also heard from Capri, that is the owner of Michael Kors, of Jimmy Choo. Those shares slightly weaker, down a third of a percent. I gotta say, this is a market that's had a hard time making sense of what the earnings look like and how to treat them. The stock was down when it first reported. It was up as much as 6% at one point in the pre-market. Again, now slightly weaker. Current quarter better than expected, but it cut its outlook from about $4.1 billion in revenue to 3.4 for this fiscal year, saying that they would have to give a range of outlooks because of the uncertainty, because of tariffs and what that means for consumer spending, something we keep hearing time and time again. Macy's, meanwhile, that is slightly higher, 0.6%, another volatile pre-market session for them. Again, this quarter beats. The CEO saying that their turnaround strategy to concentrate on the stores that are doing well is working. However, they did lower their profitability outlook for the year. And you guessed it, they said it was because of tariffs, because of uncertainty, and some of the discounting that might come because of that, John.
Macro dynamics, as they all like to say. Danny, appreciate it. The stock is up by close to 0.7%. On our radar this morning, NVIDIA earnings after the closing bell. Investors waiting for updates about AI spending and how China export controls could weigh on the chip giant.
Yeah, how do they talk about tariffs? How do they talk about the strategy when it comes to international sales and how much they weigh in on the macroeconomic dynamics or the conversation, as some people will just say? I'm also curious to see the supply-demand dynamic. What are we going to be talking about more? Supply chain inability to actually meet demand, or demand questions, particularly when it comes to hyperscalers that are their biggest customers that are increasingly becoming their biggest competitors?
I love what David Leibowitz said in terms of markets are a prisoner of policy. Don't you feel that that is really true for NVIDIA when it comes to what they can sell, cannot sell to China, and whether or not they can make up the market share based off what the president is doing with policy in other places in the world, like the Middle East?
In many ways, for many companies and many asset classes, the fate of those are in the hands of the policy of the President of the United States. And we've seen that repeatedly over the last 2 months.
Which makes it very difficult to do anything. And it makes it very difficult to really take longer-term actions. Nonetheless, a lot of companies are gleaning some insight from what we've seen recently, which is that this is a president that likes deals. So how do you get a deal done? And I love what Ed Mills said. I'm going to keep repeating this, which is as long as market participants can sniff out an element of capitalism and not ideology, they will be happy.
They'll take that and run with it. NVIDIA's up this morning by 0.6%. Some of this also affects Chevron. The Trump administration issuing a stripped-down license to Chevron, allowing it to continue minimal operations in Venezuela. Chevron will be able to conduct equipment maintenance, but won't be able to produce oil in the sanctioned South American nation.
This is interesting because this is getting a lot of behind-the-scenes debate within the Trump administration. You had Secretary of State, also the National Security Advisor now, basically saying that they were going to let this license lapse after you had Rick Grinnell, who's this special envoy for the president, actually meet with some Venezuelan officials when he returned a U.S. veteran, going on a podcast and saying, we will give a license. In the end, Rick Grinnell actually won, and they were able to get this license. But I wonder if this is one of the last few that this administration is willing to do with Venezuela, or potentially if this means talks can continue with the Maduro regime.
We talked to Mike Worth directly about this issue. This is not the volatility I'm sure that he was looking for. I wanted to squeeze this story in. This one is doing the rounds today. A new warning about the impact of AI on the job market. The Anthropic CEO telling Axios AI could wipe out half of all entry-level white-collar jobs in the next 5 years. The CEO adding firms and the government should stop, quote, sugarcoating what's coming.
Why would you have an entry-level person to come in and do data accumulation or even data entry if you could have some kind of computer program do it? This has to do with both computer programming itself, as well as legal tasks, as well as banking tasks, deal documents, etc. Here's the question, and it's not all gloom and doom for people who are saying, why bother with anything? Why go to school? I'm just going to go to a farm and farm stuff, which actually sounds great. It's also talking about what you can do to get ahead of it so that a group of people are not increasingly irrelevant in their ability to use some of these tools to augment their current jobs rather than just be completely displaced by them because what they have to offer is so similar.
Steve Bannon, which is this MAGA podcast, has been talking about this for a while, how AI is going to ruin all these jobs. And he said this is going to be a huge political issue for the next 4-8 years when it comes to the presidential race. Because right now, it feels like Washington at the moment is turning a blind eye to all of this because they're inking deals in this space.
Upward mobility is a big feature of American psyche and the American culture. You lose that and become dependent on UBI. I don't want to be dependent on universal basic income and the government and these people that we have to elect being in control of how much we earn and how much we spend.
So this is really the right question to be asking, which is, do you end up concentrating wealth disproportionately in a smaller and smaller group of people who know how to capitalize on some of the efficiencies from artificial intelligence to maximize their wealth at the expense of other people having jobs and having the upward mobility? Is it okay just to placate people with some basic level of income? A lot of people say absolutely not. Everybody needs to feel like they're needed in society. So how do you do that? And to your point, Anne-Marie, how do you get some sort of political discussion around what that looks like, whether it's education, whether it's some sort of information campaign of the skills needed in schools? And we see that. Teachers are grappling with that. I see that at home every single day. How do you deploy ChatGPT type skills without replacing the need to learn, to critically think, to write research papers and do your homework?
Unfortunately, at the moment, it's Operation Ostrich, head in the sand and hope for the best, which is probably not the best thing to do.
It's quite the opposite. You actually have to get ahead of this, and it's a conversation that needs to be had, but we are talking about other things every day. So maybe at some point we'll have that conversation.
We'll come back to this story later on. Let's turn to Capitol Hill. President Trump's big, beautiful bill set to face hurdles and undergo significant changes in the Senate after passing by a narrow majority in the House. Joining us now, the Republican Congressman French Hill of Arkansas. Congressman Hill, welcome back to the program, sir. Let's get into this. I want to understand. So here on Wall Street, as you know, there's a big sense of self-importance. When you put this bill together, how much attention do you pay to the bond market, fixed income, and what's happening on Wall Street?
Well, Jonathan, great to be with you. Look, Republicans in the House and Senate have collaborated for over a year on the components of this bill, and certainly very intensely since the election. We wanted to deliver on President Trump's campaign promises. First, redeploy federal spending, cut out some of the federal spending that we don't particularly agree with, and reinvest in the border and reinvest in defense. And secondly, block a 22% tax increase on families by extending the Tax Cuts and Jobs Act. Those were the fundamental components. And we did believe that between the Trump regulatory policies and growth policies and tax policies that we would get some acceleration in economic growth from the provisions in the tax code. But we also focused on cutting spending. And in the House bill, we cut $1.5 trillion in spending over the next 10 years.
Congressman, there's a handful of vocal senators already who want major changes to this bill. Is it going to look remotely like anything you sent over to the Senate?
Well, I'm not going to make predictions about what will happen in the Senate. We legislate every single day in the House. They legislate periodically over in the Senate. And so when they do, they have a lot of concentrated effort on it. They have to work by consensus in the two parties there, even more so than we do in the House. So I don't want to predict that. But look, I want to be clear that John Thune and Mike Johnson and President Trump have collaborated on the background and details of these bills. And that's why, based on what I've witnessed in the House over the last 5 months, I want to echo Speaker Mike Johnson's point, which is this is a delicate dance and a delicate balance. And so the Senate has to consider any major changes very, very carefully, I think.
Can a bill be big, or can it be beautiful, or can it be both?
Well, when you've got President Trump, you've got both at all times. So I think it can be significant in its policy direction and change, as well as very beneficial to American families and the growth of the American economy. And I think that's delineated in the scope of the bill that we passed in the House.
Congressman, of course, Anne-Marie was talking and referencing what Elon Musk was talking about as he seemed to distance himself, saying he's a bit disappointed that the current iteration of the bill does increase the deficit, and as he said, it seems to undermine some of the progress made by efforts in DOGE. Do you agree? Does it concern you that there is this increase in the deficit without real offsets for the longer term?
Well, I think the work by DOGE over the first 5 months of them has done a lot to uncover productivity loss, need for reform in full-time equivalent positions, how to reform IT systems, make them more reliable, reduce waste, fraud, and abuse. All those things found by DOGE are helpful. And I think they informed Chairman Tom Cole, the chairman of the House Appropriations Committee, and his colleagues exactly how to better focus FY26 spending. When we get back into session next week, you'll see the hearings in the House Appropriations Committee start quickly. And I think that's where the DOGE work will be best reflected, is in looking at FY26.
Do you think that the current iteration of the bill does enough to juice growth to offset some of the constraints that you're seeing with tariffs, with the idea that even Walmart in your home state in Bentonville is being told, eat it, and you're seeing profit margins contract or expectations for it? If you have both the deficit increasing and you have the potential for companies having to cut back, does that worry you?
Well, as I've said on your show before, I remain concerned about the uncertainty in the tariff strategy. I think we've got regulatory reform going absolutely in the right direction. I believe that the tax preservation of no cuts for households and tax incentives for business are good in the bill, including major tax incentives to bring a new plant and facilities to the United States for construction. But we need to make sure we have clarity on the tariff issue. And you're right, Doug McMillon, the CEO of Walmart, met with President Trump, made it very clear to him how quickly he believes that tariff clarity needs to be found, or it's going to impact store shelves and store prices across the country. And I think you've seen that reflected in the Macy's report that you had just a few minutes ago.
Did you get a sense, speaking to a Walmart congressman, that we will get clarity by July 9th?
Well, I believe that what I've heard from business, Dillard's department store here in Little Rock, Arkansas, one of the biggest retailers in the South, Walmart headquartered in Bentonville, Arkansas, as well as a number of small manufacturers here in the state and large, that they want clarity soon, meaning May, June, early July, because that's going to really impact planned shipments, planned purchases, and what's going to be on the shelves for back to school and this fall. So it's very important, particularly in the retailing industry. Other industries in manufacturing, maybe there's a little bit more leeway based on inventories that's been built over the first few months of this year.
Congressman, just before you go, I have a feeling you might want to weigh in on this. The Anthropic CEO and what he had to say to Axios, that AI could wipe out half of all entry-level white-collar jobs. Are we sleepwalking into a bit of a disaster?
Well, I served last year on the Speaker Johnson's bipartisan full House AI task force. We had hearings all year from every segment and walk of life, from education to healthcare to service businesses. And we came up with a series of principles. And one is you have to keep a human in the loop in applying AI, either internally or externally in a business application or a government application. And if you use it as a tool, I think it's going to be a very big productivity tool to boost economic output. And from what we heard in testimony, I didn't hear the Armageddon approach in the short run because it's such a emerging early stage tool. It's accelerating rapidly, but I think if we keep a human in the loop as we apply it internally and externally in our businesses and in government, that we're going to continue to have employees that use it effectively, and that it's not going to be as catastrophic in the short run, particularly as that prediction.
We hope you're right, sir. Congressman Hill, it's good to see you, as always. Congressman French Hill there on the latest news this morning. The AI predictions out there at the moment, and the latest down in Washington, D.C. with the tax bill.
We just ended on a point, though, that is important, which is the short run. It doesn't seem like it's catastrophic. In the medium and longer term, how do you maintain that people catch up with technology that is moving at a light speed? It seems like every technological cycle has been expedited. If we're talking about what happened with globalization and the hollowing out of industrial centers, well, do you get the same kind of reaction in certain white-collar jobs over a shorter period of time, just simply because of how quickly this is moving?
But every time you talk to someone in the AI space or an AI executive, what they say is that, oh no, you're just going to be more productive. You won't lose your job. You'll just be more productive at your current job. What Anthropic is saying is that you're not even going to have the entry-level positions anymore for anyone sub 30 years old to get on the ladder when it comes to labor force.
It's a fear that I've had for quite a while, and you echoed it just then. Will AI do to services what globalization did to manufacturing? And that's the ultimate fear that I and many others have too. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara. Hey, Yahara.
Hi, John. We start with the latest retailer to report. Abercrombie & Fitch, those shares are surging up nearly 25% in the pre-market. The company reported net sales and adjusted EPS that beat estimates and announced it repurchased $200 million worth of shares. Abercrombie also raised its full-year sales forecast in accordance with current tariff levels, but did exclude levies that remain paused. Meanwhile, President Trump said Canada could join his proposed Golden Dome system for $61 billion. Canadian Prime Minister Mark Carney confirmed the country is considering joining the U.S. on the project, but says discussions are still at early stages. President Trump also proposed letting Canada join for free if it becomes the 51st state. Quite the condition. And in sports, the Indiana Pacers are one win away from the NBA Finals after beating the Knicks at home in Game 5. Pacers star Tyrese Halliburton had a historic performance, recording a 32-point triple-double without a single turnover. The series returns to Madison Square Garden on Thursday, where the Knicks need to win to avoid elimination. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. Pretending that game didn't happen. Up next on the program, looking past Trump's tariffs.
A 10% rate is not huge enough to have any adverse consequences in the economy. It's similar to a 10% move in exchange rate.
How do you navigate all of this? We'll catch up with Marissa Adams of HSBC in just a moment.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer's not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Equity futures pretty stable here, just about unchanged on the S&P. The main event later on this afternoon, earnings from Nvidia after the closing bell. Nasdaq 100 futures positive by 0.15%. Under surveillance this morning, looking past Trump's tariffs.
a 10% rate is not huge enough to have any adverse consequences in the economy. It's similar to, it's not exactly the same thing as a 10% move in exchange rate, but things like that happen all the time. And, you know, they have an effect on the economy, and then they move on and they pass.
Here's the latest this morning. HSBC's Trade Pulse survey finding 93% of US firms feel confident in their ability to expand international trade over the next 2 years, despite current trade barriers. Marissa Adams of HSBC is a regional head of Global Trade Solutions and joins us now for more. Marissa, welcome to this program. That is quite a number. 93% of firms feeling confident in their ability to expand international trade. Can you tell us if they're following that up with investment decisions?
Thank you so much, Jonathan, for having me this morning. And we were really excited, actually, about this result. So we surveyed over 5,700 corporates, over 1,000 here in the United States. And in fact, as you know, 93% of them are confident in trading internationally, even in the current tariff disruption. And what we've seen is that U.S. companies are really resilient. They're doubling down on creativity, on innovation, how they can innovate their own supply chains, as well as invest in new technology. What we are seeing from an investment perspective, though, is that they're in a wait and watch period. You know, it's only been 7-8 weeks since the tariffs were announced, and they're starting to see some of those costs come through, but they're in a wait and watch period as to how they operate next and where their next investment moves will be.
What's driving this optimism given the uncertainty in Washington?
It's a really great question, and I think you've obviously seen from some of the results this morning and looking at your previous guest from yesterday, 10% is something that clients and corporates can absorb. And I think that one of the things they've really looked at is how they explore new markets. You also saw with a lot of corporates, both in the United States, but also abroad, was that they had the experience of COVID, where they really were able to look at their supply side, see where they could build resiliency. Now, in the current environment, they're looking at how they look at new demand markets. So it was an interesting result. What I would say is that we're only 6-7 weeks in, and we'll start to see, and this is a sentiment survey rather than anything else.
One key finding you have is the majority of these companies reported higher operating costs because of the tariffs. How does it look year end? Are those costs going up?
It really depends industry by industry. So clearly you have industries like consumer retail, which have a shorter order cycle, and they will start to see those costs come quickly, versus in the industrial sector or energy, they're longer term contracts moving through. But as I said, that 10% tariff doesn't look like it's going away. So therefore, that baseline will be there. I think there's two other things that are really interesting and we've seen in our conversations with customers. The first is that many customers, and there's so many goods that weren't tariffed previously, have never gone through a customs process. And that's costly in itself. And in fact, HSBC launched Trade Pay for import duties, which is a product where actually we will pay the import duties to U.S. Customs and Border Protection or to the customs broker on behalf of our client, and then finance that for the period that the client needs, because you pay at the point of entry rather than the point of sale. So you have a working capital gap. The second thing is on the supply side, where we've seen in certain industries, particularly consumer retail, some of the tech space, where corporates quickly moved supply to different countries earlier. And as a result, some of their key suppliers actually saw more demand and therefore increased cost as well. So we're seeing it on all those sides.
How complicated, Marissa, is it? I want you just to build on this idea of dealing with customs agents and dealing with policies that shift overnight, over the weekend, on a given day. How difficult is it for people to keep up, and what's the enforcement like on the part of some of these agents?
Well, I can't speak to the enforcement, but I can speak to the fact that it differs from two different types of companies. So if you look at larger companies, they had the experience of COVID where they really built up their supply chains. They looked at the resiliency, and actually they have larger teams able to cope with this. So in some ways, those corporates are better prepared. On the flip side, smaller companies are a little bit more agile, so they can move quicker to new routes and new supplies. So it's really a tale of two halves, and actually on that front, both sides are succeeding. One, because they have the experience of COVID and that investment, but on the other side, the smaller corporates are able to be a bit more agile and move where they need to.
Just quickly, Marissa, how much are companies investing in domestic production, whether it's in the United States or elsewhere, to just avoid having to deal with this at all?
Well, look, we've seen over the past 7 years or so a lot of investment in different industries around bringing supply, bringing production closer to home. In some ways, actually splitting production. So if you look at these corporates, as I say, the 1,000 that we surveyed in the U.S. are all internationally active. So they have domestic markets, but also international markets. And in many ways, what they're doing is actually moving production closer to those consumers. But it isn't an easy task. And we've seen over the past 7 years that actually supply chains have gotten longer, not shorter. You might have brought the assembly back closer into the United States or in another country closer to the actual domestic supply. But fundamentally, the raw materials are still coming from the same places.
Marissa, this was fantastic. Let's do it again soon. Marissa Adams there of HSBC on trade finance and what's happening with supply chains at the moment. Great to see that confidence. Fantastic to see that confidence. Not so good to see that wait-and-see mode. We're still waiting and waiting to see what happens.
They've got confidence that global trade isn't going anywhere, and we've already seen that because global trade has sustained at levels that might be less efficient but are still there. Question is, where do you move it? What do you do with it? How do you even keep track of some of the changes, let alone figure out how to comply with all of these regulations?
To your point, policy can change overnight. Call HSBC seems to be the answer there, apparently. Equity futures at the moment, positive by 0.1%. Up next, Aaron Cannon of Clear Harbor Asset Management, Gil Luria of D.A. Davidson, Nancy Lazar of Piper Sandler, and Megan Robson of BNP Paribas. The third hour of Bloomberg Surveillance is coming up next.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There is a risk premium for U.S. assets that was not there before.
Investors should be overweighting or certainly exposed to non-U.S. markets.
We're having our usual bulls versus bears debate.
This notion of U.S. exceptionalism being over is a narrative. I don't buy it.
There's nothing that beats our capital markets. They continue to be the envy of a world.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
A nice pro-American start to the third hour of Bloomberg Surveillance this morning. Good morning to you all. Equity futures on the S&P 500 positive by 0.1%. On the Nasdaq 100 positive by 0.2%. They're the scores at the index level. Later on this afternoon, the focus on one single name. Finally, wrapping up earnings season for the Mag 7 with NVIDIA.
Yeah, you talk about the pro-American start to the show. The pillars of American exceptionalism were built in large part on technology, in large part on NVIDIA, that has been whipsawed as much as the narrative has been around whether it's on or whether it's off in terms of U.S. exceptionalism. A real question of how they shift the narrative after the bell today when they report earnings. Do they lean into the tariffs and the rearranging of potential customer base? Do they lean into AI and just how quickly it is evolving? Or do they lean into the fact that they cannot meet demand still because of just the lack of chips and the lack of production availability?
Even if they are concerned with policy in Washington, they're not going to be very blatant about it. They're not going to be so direct about it because they don't want to have the ire of this president when it comes to what is going on in the chip sector. We had two different views going into this. Frank Lee of HSBC talked to us, and he said there is a narrative that shows that the Middle East could be an offset. When it comes to Morgan Stanley, though, they say there's no offset right now that they can see for what's going on, the fact that the curbs for China and the walls have gone up for their H20 chip when it comes to Beijing.
You mentioned Frank Lee of HSBC saying you won't get that beat and raise quarter that we were used to over the last several years. NVIDIA's up in the pre-market at the moment. The Anthropic CEO is the guy in AI making all the headlines this morning, speaking to Axios, warning, can I call this like employment Armageddon? Saying that unemployment could spike to 10 to 20%. We could wipe out half of white-collar entry-level jobs. That is kind of employment Armageddon.
Talking and voicing concerns as he unveiled some of the new technologies that his artificial intelligence machine learning programs could achieve. It raises a question of whether we're having the right conversation. It's not saying don't use these tools. These are absolutely productivity enhancements that could have great gains. We could cure cancer. We could make our jobs much more pleasant. We could potentially improve the way that we deliver childcare and healthcare. There is a question, though, of how many people get left out in a transition and whether it's being discussed in the correct way. I don't think that Jensen Huang's going to be talking about that today, but to see the speed at which people are adapting to some of these technologies might give you a sense of how quickly we need to expedite those conversations.
We often take the opportunity to thank the audience at home. I often say, you've heard me say it on this program, we have the smartest audience on the planet. Thank you. Proof of that. Someone writes in, AI is certainly going to impact all sectors, but we shouldn't be too quick to discount the value of having a human around to blame if something goes wrong.
I think that's actually very valid. I mean, let's be honest. There's no better scapegoat than a human who can say, I didn't do it.
They're going to blame Washington. Where were you? Behind the 8 ball. Washington is years behind where the technology is in terms of getting ahead of this and honestly what could be huge political fallout.
A massive thank you to that Bloomberg subscriber who I won't name. Coming up on this program, Aaron Kennan of Clear Harbor is going to join us as stocks snap 4 days of losses. Gil Luria of D.A. Davidson looking ahead to earnings from NVIDIA, and Nancy Lazar of Piper Sandler on the resilience of the U.S. consumer. We begin this hour with stock steady as risk appetite takes a breather. Aaron Kennan of Clear Harbor Asset Management writing, the abrupt shift in the administration's approach to negotiating can lead to high bouts of volatility. With that said, we continue to believe there are opportunities across the investment landscape. Aaron joins us now for more. Aaron, welcome back, sir. Let's talk about that word, opportunities. Where are they right now?
Well, certainly, if you look across the equity landscape, you were just focusing on AI. We still think that there's a rather significant build out ahead, and that really this idea that, you know, the data center hyperscaler spend is peaking in 2025, and that therefore there's no investment opportunity beyond that because we're just going to see a rate of change that's decelerating. I think really, you know, it misses the broader point, which is that there's going to be great opportunity and productivity gains within the equity landscape across software. Semiconductors may become more commoditized in this debate, but the design of semiconductors, the build out of the data centers, the cooling of the data centers, the need for electricity. You know, the IEA put out a report that projects that electricity demand just due to data center expansion is going to double by 2030, and that in the United States, between now and 2030, our demand for electricity is half of that demand growth is going to come from data center growth. So there's huge opportunities across the energy landscape, the infrastructure landscape, and then of course the technology landscape. And then of course, more broadly, if you look overseas, we think there's huge opportunities still in Europe. We think there's an opportunity in Japan. There's a lot of reshoring of capital there, and you've been discussing that as it pertains to the long bond. And then the rising middle class in the emerging markets. So we think there are some very macro strong tailwinds ahead of us.
Let's pick out two of them. So let's deal with tech, and then we'll get to the debt market. Let's deal with tech first, with NVIDIA earnings coming up a little bit later. The benefits of the technological progress, from the stock perspective, will they be concentrated in the big tech names, the Mag 7, or will we see those benefits more pronounced in the S&P 493 in the years to come?
You know, my view is we're going to see a broadening, and I think that broadening is because you're going to see the trickle-down benefits of the build-out, and the recipients of the build-out will be the hyperscalers and the data centers in the early innings, and then the latter innings, we're going to see the trickle-down benefits permeating the manufacturing floor. You know, we used to talk about lean manufacturing. You apply AI and robotics, it takes it to a different level. You think about sort of the hospitality sector and applying AI there, or healthcare, as you referenced earlier, and AI as it pertains to robotics, and increasing hygiene and increasing outcomes in a more positive way. So we think there's just a huge opportunity set in that regard.
Aaron, it really raises the question about whether the risk is shifting away from the stock market into the bond market. If you have margin improvements over the long term, not necessarily the short term, if you have efficiency, productivity gains at a lot of corporate levels, at the same time that you have a real churn on just the base of people who live in a country, and this question about the overhang of debt, do you see a better, less risky prospect in stocks right now than in government bonds?
Well, you know, one is not able to live without the other, and the cost of capital certainly impacts the vast majority of the equity market, and we always have to keep that in mind. But, you know, if you think about, you know, the glass half full component, I mentioned Japan earlier, when you have rates trending higher, that yen carry trade disappears. Capital is brought back to Japan. It's not just Mr. and Mrs. Watanabe's capital, it's also institutional capital. And so that reshoring can augur very positive tailwinds for the financial sector and also for other areas of the economy. But for certain, in the United States, we should be concerned about higher deficits and what it means for the long end of the curve. But we should also keep in mind, too, that the average maturity of the outstanding U.S. Treasury profile that exists here in the United States, our $36 trillion debt, is about 5.5, 6 years. It's not the long bond. It's not 30 years. That's about 17% of our outstanding Treasury debt. And I think we need to keep that in mind as well.
What's driving the bond market? And I mean, you reference this question of issuance and maturities. Is that the issue? Is it inflation? Is it some sort of shift of cash away from U.S. markets to domestic markets, as you were referencing with Japan?
I think it's multivariable, Lisa, to be honest with you. I think it's a concern at the end of the day. If you look at countries where we have a trade deficit, are not just, you know, buying our treasuries because they like us. They're buying our treasuries because they're trading with us. And if there's a tendency for us to trade on the margin a little less with countries where we have trade deficits, they're going to have less incentive to own treasuries. So that would be a little bit of a headwind. Our deficit projections at 7-8% deficit to GDP, that's not a positive tailwind, particularly for the long end of the curve. The front end of the curve is more controlled by the Fed, as we know. And so that's why we have, you know, a rather significant disparity right now between, you know, front end yields and long end yields. But, you know, multifactorial for sure.
You're touching on a really important dynamic, though, a really important process, Aaron, which is at the moment we don't want their exports, but we want their capital. Can we have one without the other?
Well, I think this is a wake-up call to that reality, and I think there may be a longer-term thought that maybe the savings rate in the United States can move up so that what happened in Japan since the late 80s through about now, which is that the savings rate really rose markedly, even though it's a developed nation, could somehow be reflected back here in the United States, where individuals start to save more and buy more in the form of treasuries. I think we're a long way away from that right now, and I think that's one of the challenges. You know, every 75 basis point rise in the total weighted average cost of our treasuries is about $275 billion. I mean, that was our Navy budget last year. So big challenges if we don't get this under control.
Well, for every spending, every $7, one of those dollars in the U.S. spending goes to paying off our net interest. Amidst all this policy uncertainty in Washington, of course, we have the one big beautiful bill as well. Do you find that this bill is a tailwind or a headwind at the moment?
Well, in the short term, when you look at where we thought it was going to be 2 months ago, it's now representing stimulus, where we thought it was going to represent more of a Doge-lined, sort of bit of hawkishness. And maybe contraction. And that's why I think some of the commentary just a few weeks ago and months ago, and I was articulating this, was, well, we're going to have a lot of stimulus in Europe, but we're not going to have a lot of stimulus coming out of this bill in the United States. And so therefore, maybe want to reallocate capital to European equities. Well, we're going to have about $300 billion of stimulus if this bill passes. I think in the long run, though, will this create a Liz Truss moment in the short to medium term, which is going to cause problems for our deficit in the long run? We'll have to see. Will those bond market vigilantes come home to roost?
Just to jump in here, what do you really see as stimulative? Because isn't this just an extension of current policy?
Yeah, I think if you look at, some of the extension of part of the IRA, it's still stimulative. You're right. If you look at the extension of the Tax and Jobs Act, it's still, it's about as is. But if you look at the provisions around interest for your property taxes at the local level and the increase in standard deduction, things like that, it's incrementally stimulative. I think it's considered about $300 billion the last I saw. But again, those senators are there are 3, 4, 5 Republican senators who are no-go on this. So a lot can change between now and, let's say, the vote.
Aaron, appreciate your time, sir. A lot can change. Aaron Cannon there of Clear Harbor Asset Management. Finishing things up there on the bill, working its way through Congress. Equity futures this morning, positive by 0.1% on the S&P. That's the price action. For an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Elon Musk will face a lawsuit over his work at Doge. More than a dozen Democratic state attorneys general brought the case, saying Musk wielded illegal power in orchestrating President Trump's cuts in federal government jobs and spending. The judge said the administration adopted a perverse reading of the Constitution with the Doge effort. Meanwhile, the Trump administration is raising the stakes in its ongoing battle with Harvard and other universities. Secretary of State Marco Rubio ordered U.S. embassies worldwide to stop scheduling interviews for student visas. This comes as the U.S. considers stricter vetting of applicants' social media profiles. And in sports, LA Dodgers phenom Shohei Ohtani became MLB's first player to reach 20 home runs this season. He's now just the third Dodger ever to reach the mark within just 55 games. Plus, it marks the third time ever that Ohtani has homered in 3 straight games. The milestones came in a 9-5 Dodgers win over Cleveland. That's your Bloomberg Brief. John?
Absolute animal. Unreal. Yahara, thank you. Up next on the program, the Morning Calls Plus. Gil Luria of D.A. Davidson with all eyes on earnings from NVIDIA. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
The opening bell 1 hour and 14 minutes away. Equities positive by 1/10% on the S&P, up by close to 0.3 on the Nasdaq. Coming up a little bit later in the bond market, the focus will be on $70 billion of 5-year notes tomorrow, $44 billion of